So great place to get visibility, meet some like-minded co-founders. So go ahead and change your name and put something in the chat. And someone has a dog barking.
I am guilty. Guilty as charged.
Oh, is that Dean's dog?
Yeah, I think so.
All right. I know Claire just brought home a puppy. Claire's our marketing associate. All right. So it seems like the numbers of right 39. Seems there's 40. Okay, kind of watching the ticker go up. So yep. So for those of you that just joined, we're just letting the room fill up. If you want to change your name, maybe Stephen, you can write that in the chat, like how to change their name and to add their just a little introduction in the chat. Yeah. All right. So we'll give it one more minute. 41 folks. Hope everyone had a nice Thanksgiving break. I get my slides ready. Everybody can see that. All right, so it's been 5 minutes. Everyone's in that's going to be in. They'll just keep filing in. And so welcome to the San Diego Angel Conference. This is the Entrepreneurs Track. This is a like an accelerator to help founders get ready to pitch to angel investors. And specifically, we have the San Diego Angel Conference that kicks off with the application deadline in December. And so we hope this will help prepare you for that. We're at 15 total sessions, and I'll go over the schedule in a little bit. So we are hosted by the Canal School of Business at the University of San Diego. If you've been to any of our in-person events, you've had a chance to come to our beautiful campus, and we align with our university's mission of advancing academic excellence for a more hopeful, sustainable, and inclusive world. And the San Diego Angel Conference would like to recognize and thank our sponsors, our title sponsor, C3 Bank, and our sponsors, Platinum and Gold. Some of them you've become very familiar with, who they've spoke, like Mintz has come and spoke at one of the E-Track events, Coeptus, Brian Dirkmatt, and ClearPoint, Bonnie Shaw and Hillary McCarthy from ClearPoint Agency will be talking about how to use PR to generate awareness and more at our session next week. So I'd like to thank our sponsors. And of course, we have a wide variety of partners that support our innovation ecosystem, including New Fund Venture Group. We have and the co-fund, which maybe isn't on here, but that's where our special guests today are representing our partners from the innovation ecosystem. So I have a few announcements before I introduce our speakers today. We have a new session that we've just created, and it's going to be for folks who are submitting for an SBIR Phase 1 in January. So we have an SBIR workshop that we put on 4 times a year. It's a 4-week series. We have a lot of people that join that to just kind of see what it is, see if it's right for them. This session, these are Q&A sessions to help you submit in January. So this is for the people that are submitting, serious, I'm going to submit, I want to get some questions answered, and we're going to have our Brink advisor, Martin Gleason, will be hosting to address any questions or concerns. And so we're going to have 2 sessions, one on December 4th and one on December 11th at 3 o'clock on Zoom. So you can scan the QR code, or Stephen will put a link to the registration in the chat. And then when you register, you will get the link to the meeting. We're very excited about that. Okay, so about the San Diego Angel Conference and the Brink. We are part of the Free Enterprise Institute, led by our executive director, Misty Rusk. And we have community-facing and a continuum all the way to student-facing events. And so our community-facing events includes the San Diego Angel Conference, which is open to the community to pitch and win angel investment, all the way to the Fowler Business Concept Challenge, which is kind of like a model of the San Diego Angel Conference, but for students to try, and then they win like scholarship money. But we try to model the pitch events for the students as well. And then I'm the director of the Brink, SBDC, this one over on the right, and we provide free and confidential one-on-one advising for innovative founders. And innovative founders to help you build investable companies. So we help you with capital access. So access to capital like non-dilutive funding, like an SBIR grant or angel investment. We'll help you put together your business plan and help you grow your revenues. And so there's a link to our website below. And we are part of, we have 16 advisors. We have a lot of advisors. It's a wonderful team of accomplished advisors who are experts in their field, from life science and biotech to devices, AI, SaaS, software. It runs medical devices, healthcare, and some legal expertise as well. So when you meet with the Brank, you have access to all these advisors, and you can pick one, or you can move around and meet with many. But that's not all. We're part of an 11-center SBDC network in San Diego and Imperial Valley, and that includes Connect as well. So lots of times our companies get an angel investment and then move on to Connect when they'll help them find venture funding. Lots of companies come to Connect. Connect says you're too early, and they send them to the Brank at USD. And so we're a network where we have access to over 100 expert advisors. And we all with the goal to generate economic impact in the community. And so we do one-on-one advising and events. It's free for the founders. Last year, we did 16,000 counseling hours for over 4,500 clients. This is network-wide across our 11 centers. Our women, we have just under 50% of our clients are women. Just over 50% of our clients are people of color, Asia Pacific Islander, Black, African American, and Latin ex-Hispanic, and all generating over 1 billion in economic impact. And so you can have access to free advising, one meeting, multiple meetings, review your pitch deck, look at your business model canvas, just have someone to talk to. So you can start your free advising, scan this QR code and sign up, or Stephen will put a link in the chat as well. And you don't have to be a Brank client to submit to the San Diego Angel Conference, but we're here to help you review your pitch decks and get you ready. And I know a lot of you, you sign up and then we give you a link to meet with an advisor. So some people haven't quite signed up yet. I know, because I pay attention to our registration. And then some people sign up, but they haven't actually met with their advisor. So we'll send you some reminders to help get you on track. All right, so we're very excited because we've been asking you to follow us on LinkedIn, and I should update this. Last time I looked, we were at over 1,000. We met our goal. And so we invite everybody to follow the Brank on LinkedIn, and that way you can get updates about the events that we are hosting. And I think Stephen will also put a link in the chat if you don't have time to scan the QR code. All right, so what is the San Diego Angel Conference? So the San Diego Angel Conference includes the E-Track and the I-Track. So the E-Track is what we're doing right now. We started that in September, and it ends in a couple of weeks in December. And it's really an accelerator to train and get founders ready to pitch for angel investment. Our application deadline is December 19th. And then the I-Track kicks off, and that is where we activate accredited investors in the community. So folks that have been thinking about angel investing, don't want to make a large commitment, so they buy a very small investment unit. Together, they pool their funds, targeting 200,000, and award that as investment to the winner. So they review all the applications that come in at the application deadline, and over a series of voting and events, they identify 6 finalists, and that's where they roll up their sleeves and they do due diligence, what we're going to talk about today. And then those founders those 6 founders present at the finale on stage, and the investors vote for a winner. And every time we've raised more than 200,000, and we were able to award investment to more than one company. So we encourage you to consider this. If you do want to apply, the deadline is December 19th. Here's the QR code. There's a link in the chat as well that will take you to the application page, which will take you to GUST, and that's where we put all of your information. All right. Also that day, we're going to celebrate the end of the E-Track and the application deadline, and this will be a little party at a company, or I think it's a co-working space called Downtown Works. It's in Carlsbad off of Pelham Airport Road by the airport. Very nice space. So scan the QR code, register if you'd like to attend. There's no content, there's no learning. It's just meet the people that you've been engaging with and just celebrate, and a little bit of a holiday party too. All right, so before that, we do have a couple extra events. We still have one more pitch deconstruction in December. That's your last chance to practice. We had a great turnout in November with one of our key grant funders was there. She was very impressed with our show, so thank you for that. This is going to be December 12th at University of San Diego, so go ahead and register for that. Come ready to pitch, or you can just watch, but we'll probably rope you in and get you on stage. Just 1 minute pitch. Okay, so here we are in our 15-week e-track series. We are here on the 28th preparing for due diligence. Next week is going to be Maria Blanche Gonzalez from Crescent Partners and Hillary McCarthy from ClearPoint Agency. And then we'll also have Natalie Castellano from Terra Bio, who received investment from SDAC, to talk about business models, business channels, and go-to-market strategy. And then we'll come back to in person with our pitch deconstruction and the final party. All right, so if you buy a ticket, if you register, if you apply for SDAC, you get a free ticket to the finale. So save the date, attend the finale for sure. All right, so we'd like to know if you're going to apply for SDAC. So if you are, let us know who you are, if you're applying, if you're not, because we know who you are, or maybe you haven't decided yet. So it just gives us a good idea of the number to expect. And I think Stephen will put a link in the chat for that as well. All right, so let's get down to what we're doing tonight. I'm so excited that we've got a great lineup. This is about due diligence. So this is when you've made your pitch. I'll let them tell you about it, but this is like, you got to like go into like Q&A, deep dive into your company. So let's learn what that's all about. And so we have JC Ruffalo from Co-Fund, and we have Dean Rosenberg from the New Fund Venture Group. And then we have a special guest, Patrick Schnidley from Kari Health, who has been on our earlier e-track, who will give that founder's perspective. So they are each going to go over their a little bit about their background, and then we'll do a moderated panel of Q&A, and then we'll end with Misty Rusk is going to talk about how to get your stuff organized for due diligence, get all your folders and your information. So with that, I'm going to introduce, I think I might have my my schedule here. Let me just, oops.
It might be backwards, Amy, but we can go with the flow, whatever you want to do.
Dean, you're next. So let me introduce Dean. I want to not share anymore. Am I still sharing?
You are.
Okay. Stop share. Thank you. Okay. Yes. So next is we're going to start with Dean. He's going to talk. Dean Rosenberg is a fund manager with the New Fund Venture Group. He's going to talk a little bit about what his background and what the New Fund Venture Group is all about. And then we're going to move over to JC Ruffalo, who will talk about his background, but then also go into a little bit of a primer on what is due diligence. So Dean, thanks so much for being here tonight. We're very excited to hear from you.
Cool. Yeah, thanks, Amy. And super cool to see all the different companies in the chat. So thanks everybody for joining us. And also to see all the new fund members who are advisors to SDAC. That's very cool as well. So again, my name is Dean Rosenberg. I have been in the startup scene for over 30 years, mostly in your seat. So for 20 plus of those 30 years, it's been as a entrepreneur founder, sometimes with co-founders, sometimes not. And in full disclosure, most of my ventures have been pretty horrific failures, as many startups are. But fortunately, I had one or two successes, and that allowed me to kind of come onto the other side of the table and become an investor about 10 years ago. I've been a very active early stage investor. Some would call it angel investor or venture investor. I'm personally invested in over 20 companies. I've been involved in New Fund Venture Group. I'll talk about that in just a moment. For about 7 years. And I'm also one of the fund managers for the fund at New Fund Venture Group. I'll walk you through. Can you all see my screen?
Yes.
Okay, cool. Okay, cool. So I'm actually at newfund.com right now. So you can visit that at your leisure, nufund.com. Caitlin is our current president, very, very active angel investor in town, is involved in a lot of companies and has done amazing things for our community. She's actually on her way out, finishing her term as president at Newfund, and Sirhat Paula will be stepping up shortly in the next few weeks. So we have over 300 members. We invest out of a fund. So if the way the process works is you would fill out an application, or you would be brought in by one of our members, and then you would present to some group within Newfund. So for instance, if you had a semiconductor venture, we have 20 or 25 members from Qualcomm. If you if you have a life science or a medical device company, we have about 150 members that are in biotech and pharma and medical devices and health tech. And so, in the areas that we focus on, we will try to pair you with one or more of our members to have an open conversation. It's a little bit less formal initially, but you'll likely go through your pitch deck and you'll walk us through what you're all about. And that the purpose of that first meeting is really to identify whether your company has the attributes to successfully receive funding from the group. We invest about $12 million each year. Typically, in a company round, we're investing between, let's say, $300,000 and $1 million. We lead with our fund. Our fund invests approximately $6 million each year, and up to like this year, I think our fund invests up to $400,000, and then our individual members will often also make individual investments if you, as an entrepreneur, want to take sort of individual checks from investors as well. A fun fact is I was actually a portfolio company of Newfund. Back then it was called Tech Coast Angels San Diego. But in 2005, I presented to Newfund, raised $2 million for my venture, had a successful exit several years later. And that was actually the exit that allowed me to kind of go to the other side and actually join as a member and actually be able to make individual investments and be very, very active in both in the local startup scene, but also I also invest outside of San Diego and outside of Southern California as well. So we talked a little bit about our process. We're going to be talking about due diligence today, and so, one of the things that separates us apart from some VC firms and other angel groups is we intend to complete substantially all of our due diligence in one meeting. So after you present to us and we are excited to move forward and to learn more and kind of lift the hood and learn more about your company, we schedule a 2 to 3 hour meeting, and our intent is to complete 80% of our due diligence in that meeting. Now the sort of the dirty secret of that is more than half of the companies that we have that meeting with, we don't continue after that meeting. And that has a lot to do with, you get to present the most perfect view of your company in a 7 or 10 or 12 minute or 20 minute, pitch and Q&A. Due diligence is where we sort of peel back all the layers of the onion and we realize, oh, it might not be as perfect as it sounded in the pitch deck. And then we make a decision at the end of that meeting whether to continue or not. If we make the decision to continue, we then just decide what boxes are left to check. Maybe we want to talk to a customer. Maybe we want to review your patent application. Maybe we want to, do a little bit more work around your finances. But we come up with what the checkbox items are, and we attempt to address those in the next several weeks. And we make a commitment that we will get you to yes or no within 30 days. Which is a huge improvement from where many angel groups are today and where we used to be several years ago. And then we also, connecting with JC at the Cove Fund and dozens of other micro VCs and venture groups and accelerators, we can also get you additional visibility to, if you're trying to raise $2 million and we can lead the round with 800,000, we'll then find syndicate partners and work with you to fill out the rest of your round. So on the entrepreneur side, our pledge is we'll treat you with respect. We understand that time is money, literally. We will respect your time and get to yes or no. We talked about the 30-day due diligence and leveraging our network. So I think maybe, Amy, I'll stop there and I can address anything more about Newfund in the Q&A as we kind of continue on tonight.
Yeah, that sounds great. Thanks, Dean. And that website really does double as slide presentation. So
yeah, that's cool, huh? Yeah.
That's really cool. So, Stephen put the link in the chat. So everybody, if you missed anything, go back and visit it because it's not like it's outdated. It's a pretty new website. Everything is how they perform. So thank you, Dean, for that. And then we'll regroup in a moment. So now I'd like to introduce JC Ruffalo from CoFund, who's going to tell us a little bit about how CoFund operates. And then he'll move into some slides to just cover some of those due diligence basics to make sure we're all on the same page. So welcome, JC.
Thanks, Amy. And Dean, great presentation. You took a lot of the same stuff that I was going to present. A lot of overlap as we collaborate very often. So I'm JC Ruffalo, partner at CoFund. We're a seed stage venture fund based here in Irvine in Orange County. Our fund focuses specifically on Southern California-based tech and life science startups. We are a generalist fund at seed stage, so companies raising really their first institutional round of capital. Seed stage is kind of a moving target, but in terms of the range of the amount that companies are looking to raise is somewhere between 1 million on the low end and about 5 million on the high end. Where we tend to fall is really that 2 to 3 million. We do tend to lead a majority of the investments we do invest in. And our initial check sizes start off at about $500,000. This is our third fund. We're almost a $30 million fund for this third fund. We've had 2 prior funds. We've invested in about 47 portfolio companies to date. 7 in this new fund, 20 in the first, 20 in the second, and now, as I mentioned, 7 in this third. So yeah, we focus specifically on Southern California. We understand that there's a huge lack of access to capital here locally. My background, I've been an entrepreneur 3 times in 3 various industry spaces, one in clothing and apparel, another in email marketing where I had to raise outside funding, and then my last one was in heavy hauling in the heavy kind of mechanical industry and transportation. And then prior to joining CoFund, I actually ran the Launchpad SBDC Center at Octane here in Orange County, if you're familiar with Octane Launchpad. So I joined CoFund 3 in 2021 for when we launched CoFund 3. Been very active and seeing a lot of the deals here in Southern California and participating in, about 40 plus due diligence processes into startups, and we only invest in about 7. And to give you kind of a funnel, we've seen over 1,600 companies. We've diligenced about just slightly under 100, and we've invested in 7. So we have a pretty high bar. And like Dean mentioned, usually in our first meeting, we get about 80% confidence that we want to continue to dive in for further diligence meetings. So maybe it'd be good for me to dive in and share my screen here. Give me one moment. Hopefully everyone can see my screen.
Yep, your slides are up.
Sounds good. Perfect. Let me just move my little Zoom bar here. Perfect. So here at CoFund, I want to just dive in here with kind of what do you expect? You being an entrepreneur, I've been in your shoes. One thing I really wanted to start this presentation with is alignment. So often there's misalignment, whether it's, there's miscommunication, there's, industry, not a right industry fit. And maybe the entrepreneur is not being as honest or as forthcoming. So effective communication, clear transparency, and ensuring that there's alignment are kind of the key 3 takeaways initially that we look for when we're looking to diligence a deal. Have a data room ready. This is so critical. I've quickly outlined about the 7 kind of key things that we look for in a data room that you should have, starting with maybe the founding team's background, whether that's your resumes or maybe some articles or some publishments that you've done, or anything about kind of your org chart, anything like that. Your backgrounds is critical. For us as a seed stage investor, team is everything. We really make probably, more than half of our decision making is based on the team. So that's really critical and important. Secondly, your financials, the cap table, any kind of prior deal docs, prior funding rounds, all of that we want to see. If you have kind of a business plan, kind of a breakdown of everything, your market potential, so a clear market understanding, we want to see that, as well as a revenue model that supports your financial model. We want to understand that, as well as the growth strategy, kind of your sales and marketing, a competitive analysis report based on the market, and then any kind of legal documents. So whether you create this on Carta or, Dropbox or anything like that, that you can easily distribute as you go out and approach different institutional investors. These are kind of the key items we look for or ask for. So one of the things that maybe gets kind of time is everything, as Dean mentioned as well. So we don't want to waste anyone's time, ours or the entrepreneurs. So valuation sensitive. We want to make sure that this current funding round fits our thesis as a fund, as well as your expectations on what you want as an outcome. So make sure you're clear and concise with your investment terms, the investment vehicle, the valuation, any prior investors, or maybe there's a lead investor already in place. A clear breakdown in the use of funds is critical and important. We want to understand where our money is going to be deployed and what's going to be deployed into. We want to understand what milestones you look to achieve with this. And then we also want to understand how long until you need your next fundraising round. Is it a year? Is it 18 months? Is it 2 years? And so on. So make sure you kind of hit that up front. Whether that's during the Q&A session as you give your first presentation and then you dive into your first meeting. At some point, a lot of things kind of get stalled in valuation expectations and making sure it's a right fit. So again, going back to my prior slide, alignment fits in this as well.
And JC, I might just mention some of the companies, just looking at the chat, if you're super early stage, you won't have a lot of this stuff. So don't be too distressed by that. Your deal room should, and deal room also is a fancy term for a directory that you can share with us so that we can see your documents. So we're looking for what we need to make our decision. And if you're missing something, we'll ask for it. And then if you don't have it, we'll decide whether you should put it together.
It's a great point, Dean. Yeah, I would say that we deal with a lot of early stage, whether that's angel, seed, pre-seed, the terminology changes. We don't expect all of that to be hashed out, but we want to have some sort of understanding. So to those on the call today, if you don't have all of these, it's totally acceptable for us to still engage with you to get an understanding of where you're at. So yeah, thank you. I agree, Dean. Thank you. So management team, as I mentioned, that really is a key decision maker for us. We want to understand the team, their backgrounds, their industry expertise. I will say that all the companies we've invested in, save maybe a handful out of the 47 in total, very rarely are we investing in these new college graduates, doing something, new. Most of them are, been in industry, and some sort of corporation or something, and saw a flaw in the market or whatever their company was doing, and they pivoted out and thought they could do it better. So we really are looking for more seasoned entrepreneurs, if you will, that understand what it takes to keep the lights on, make payroll as a seasoned entrepreneur. That's a plus, but again, not mandatory. But again, team assessment is really a key. So then we go into your product and solution and really your growth potential for the go-to-market strategy. But really just want to understand what progress you've made to date with your solution. What milestones? Do you have any customer market validation? Maybe you got early beta testers or even alpha testers. Maybe you've got some early revenue or some traction. That's always good to know. Good to also know maybe some churn. LTV to CAC, if you're a SaaS company, want to understand that. But really just want to understand that there's key market validation that understands that you have a solution that's unique in this market, and you're better, faster, cheaper, stronger, or maybe you're just two out of those. That is still a unique value proposition for us as well. Market opportunity, and I probably feel like I'm not telling you in the audience something that you don't already know. A lot of these slides are reflective of what you're presenting in your pitch, whether you're doing a 1-minute quick pitch or a 20-minute presentation. It's all just more substantive in the diligence process as we unpack all of these and really take a deeper dive and a deeper analysis in this, from the first meeting to maybe the 10th meeting as we go into it. So understanding the market opportunity, is it a big market or is this a lifestyle business? Is this something that you're, do a healthy business, but maybe not venture backed? So there's different, analogies and different opportunities. But for us as a venture fund, and I should state this, that we're looking for 20 to 30x multiple for each deal that we are looking at. So we're not looking for maybe a single or a double. We have a different appetite for investment. So the technical due diligence, this is where we have the most fun, I want to mention too, in our diligence process, we're very similar to the new fund. As a fund, we have about 90 LPs that make up our investment base. And we're able to tap into our LPs for their kind of brain trust, their expertise in specific industries. and they can help us assess the technical aspects of it. So I love being a fly on the wall and understanding things that maybe I'm not as dangerous in. But for this, as you prepare your kind of data room, make sure that you have a lot of these things that you're prepared for, that you're able to share with the diligence team or the investment team to understand kind of what your technology does, how, what the unique value proposition is compared to the competitive analysis, the product roadmap, how you're going to continue to build out feature sets, and then also kind of your intellectual property, so your IP. And hopefully you have some IP, or maybe you have secret sauce, or maybe you've figured out a way to create a moat, or maybe you even have a freedom to operate. All of those are something, or those questions that we're going to ask you in the diligence process. So again, as I mentioned, just IP, it is something we look for, but we're not asking for, it has to be patented, it has to be issued, can be pending, or maybe you're just approaching the PTO, or you don't even have a freedom to operate legal opinion yet, but we will kind of walk you through that. And for those of you that may not be familiar with a freedom to operate, that just makes sure that you're not infringing on some other IP that's already outstanding in the market. So IP is critical for us, and can be a deal breaker. So simply competition, we just want to understand the competitive landscape, who else is out there, what are you doing that's unique, and how you're able to kind of build out a little sliver of the market. So we'll do a deeper dive into the competition, maybe even kind of reach out to them and understand what they're doing as well, or maybe they might be even a likely acquirer of your technology. In terms of the financials, we really want to understand the financial model, what it takes. Now, you hopefully in your presentations and some of your presentations to certain audiences, you have a quick slide that shows kind of the revenue potential and the financial potential, whether it's total revenue and gross margin or EBITDA or something to that effect. And then you have that deep Excel. So we're going to take a deep dive into that Excel. We're going to analyze it. We're going to put our investment into it, the total investment of this round, as well as future subsequent rounds, and understand what the kind of exit potential would look like for us. Want to understand kind of the burn rate, how much runway you have, and then just understanding kind of what the business model that reflects your financial model really is. So quick analysis of the financials. And then, as I mentioned already, kind of our exit strategy. We're looking for 20 to 30x returns for our investment to make up our portfolio. So make sure that you have a well thought out kind of execution pathway for an exit, whether that's to be acquired by a strategic, or maybe you go IPO, or you want to take this for a long haul, whether that's 10 plus years. And I should mention for co-fund, we are a seed and feed fund. So we make the initial investment and we'll follow on for follow-on rounds. Every deal that we're looking to invest in, as I mentioned, the team is critical, because we understand it's a 5, if not 10-year relationship with that entrepreneur. And you can pivot the market, you can change the technology, tinker with that, but the last thing we want to tinker or change is the management team. So just have a well thought out exit opportunity for us. And then in conclusion, just having a well thought out deal data room is important. If you're able to create one, I would start sooner rather than later. And it's really more about finding the right investors that are not just bringing capital to the table, but what I like to call relationship capital. So it's just as much as a courtship during the times of diligence, or even when you're presenting to potential investors, to understand what they bring to the table besides just the capital aspect. Is it strategic relationships? As I mentioned, and like New Fund has, we have a lot of LPs that make up our fund. So we want to bring a lot of value, whether that's operational, resources, talent, whatever it is. We want to add value for the long term to be successful. So with that, in closing, thanks for listening to me ramble. Hopefully it was somewhat insightful and helpful to you all. I'm happy to share the deck. My email is on here if any of you are interested in reaching out. I'm happy to have a conversation with all of you if it deems necessary for co-fund, for a potential investment, or maybe I might know another group that might be a better avenue for you to consider. So with that, Amy, I will go ahead and stop sharing my screen.
Yay, thank you.
I'll hand it off back over to you.
Thanks for that. So for the founders on the call, this looks like a pitch deck. Like every slide that you talked about that you go into for due diligence is a slide in a pitch deck. But I sort of look at, you could put a pitch deck together and you have like your high level stuff, but behind the slide, there better be like well thought out, what I want to call a business plan, but you should have something like a business plan, like some sort of Excel sheets and well thought out things, because they're going to ask about it. So that's what he was talking about. So all of that is relevant. So that just mirrored exactly the pitch deck that we've been sharing with the founders. So thank you so much for that. Now we're going to go back to Dean. He's going to show us the questionnaire from New Fund, which we actually we mirror that with the SDAC. So if you become one of those 6 finalists, we've sort of had permission and approval to use the same questionnaire, so that, it's kind of like when you get ready to use it. So Dean, talk to us about this questionnaire. What is it and when does it come into play? When do they fill it out for New Fund?
Yeah, I'll do that. So in a moment, I'm going to bring up actually the questionnaire, which is the actual specific minimum questions that we need answered in order to actually get you to the finish line. There will likely be other questions that come up, but these are kind of the minimum questions. Before I bring up the questionnaire, I just want to follow up on something that JC said very quickly, but it's really important especially for many of you who have smaller, what I would call lifestyle businesses. And a lifestyle business is a business that can be incredibly successful for you and your family, but is not necessarily going to generate meaningful return on investment to investors. That's sort of one of the definitions. There are other definitions. A lifestyle business, typically you're engaged in the business, whereas ventures you're typically looking to sell. But one of the things JC said is the co-fund is looking for, I think I might have this wrong, JC, but I think you said a 20 to 30x return, which is a very, very big return. I wanted to just very briefly touch on that, because part of this due diligence conversation is you understanding whether you should even get into this game of pursuing venture money. And I state that a little bit different than we're seeking a 20 to 30x return. What I say for when we're looking at a potential prospect for new fund investment is I want to see a company that has a product that's 10 times better and that can deliver 10 times return on my investment. 10 times better and deliver 10 times my return on investment. And so what you might be asking is why? Why can't it just deliver 2 times return on investment? 2 times is a pretty good return on investment. The treasury bills pay 4% or whatever it is. Why aren't I satisfied with 2 times? The reason is, if you look at a portfolio, either in JC's portfolio or New Fund or my personal portfolio, if you just take 10 companies in our portfolio, as venture investors, we expect 5 of them to go to zero or to not return capital to us. We expect 1 to 3 of those 10 companies to return something not interesting. And we hope that 1 to 2 of the remaining companies are home runs. And it's those home runs that drive the returns in the rest of our portfolio. So if we don't have every company that we invest in have the potential for a 10 times return, we're sort of setting up our venture portfolio to fail. And so when we say we're looking for 10 times better and 10 times ROI, we want that to be possible. We know that every company in the portfolio isn't going to achieve that. But if you present a pitch deck to us that says, this is my really cool NewCo, it's producing this widget, and if you give us $2 million, next year we're going to be doing $100,000 in revenue, and 5 years from now we're going to be doing $350,000 in revenue, we won't be interested. So I want to bring that up first before I get into further due diligence, because I think some of you may self-select out saying, you know what, raising investment money isn't for me because I'm not looking to actually launch and grow an explosive growth startup, which is what investors are typically looking for. So I just want to kind of point that out before I got into the thing. So let me share my screen here.
Thank you for that, Dean.
Sure.
That's the 20 to 30x return is important. And if you can do it without, if you have a lifestyle company while you're setting up, if you can get your own personal return for yourself without having to dilute yourself, that's a win as well.
And I'll say that a little bit more crassly. Investors suck. So if you can grow your company without taking outside money, you should definitely consider doing that. If you're in life science, we just had a very successful outcome for one of our portfolio companies at New Fund. It's a company called DTX Pharma. They just got acquired for $1 billion. But in order to get acquired for $1 billion, they had to raise almost $200 million. And so that's just a very different level than like my software consulting company that I had early in my career, where I made $2 or $3 million a year. I wasn't beholden to anybody. I took half of that to the bank, and I actually had I made a very good living. But it wasn't an investable company. Nobody was going to invest money expecting that my $2 million consulting company was going to be worth $2 billion in 5 years. Okay, can you all see my screen? Can somebody give me an audible yes?
Yep, I can see it.
Okay,
Yeah,
cool.
yeah.
Okay, cool. So this is, I think this is like a 5-page document. It can typically be completed in less than an hour, and it's what we ask you to complete before we start that first due diligence kickoff meeting. So this would be completed after you present to us, after we decide that, yeah, this is a company that's in profile for us that we want to learn more about and that we want to move to due diligence to have that due diligence kickoff meeting. So the first section is about intellectual property. JC actually took this a little bit further than we do at New Fund. He said intellectual property is, almost table stakes or a requirement for investment. We have many companies we invest in that IP is not a meaningful part of the investment thesis. With that said, we want you to have some sort of competitive advantage, and intellectual property is one of the key ways to have that competitive advantage. And some will refer to competitive advantage as a moat. If you think of the old castle, you're in the castle and you want some sort of moat, keeping all of the competitors away and allowing you to continue to prosper. The reason that's important is because nothing's worse than you actually having a great innovation and a great product and something that can change the world. And then you educate Apple, or you educate Google, or you educate GM or Ford. And then you don't get to benefit from that innovation because you didn't have anything protectable. They saw what you were doing. I mean, most of you don't remember, the first, streaming audio device. It was a Rio. I don't even think that company is in business anymore. It got replaced by the iPod, and then, obviously smartphones and such. And so, when we as early stage investors invest in your company, we need to understand that there's some competitive advantage. Some will call it an unfair competitive advantage. What is special about your company that will make it hard for somebody else to replicate this? A patent is one way. And so these questions in the survey ask about, do you have a lawyer that's focused on intellectual property? Do you license any other technology? So if we invest in your company, we want to make sure we don't think that there's intellectual property that's yours, but actually you're paying a license fee, or you're buying or licensing somebody else's technology. There's no problem with you licensing somebody's technology. We just want to know about that. And then similarly, have you already sort of sold off some benefits of your technology? Did you already, for instance, give away your IP or license your patent for use in a specific industry? And so we would want to know about that. Have patents been filed for? Have they been allowed and issued? Have you done a patent search? JC mentioned a little bit about freedom to operate. That's a tricky one because a formal freedom to operate process is quite expensive. And so at New Fund, we sometimes leverage our lawyers who are actually members of New Fund to do like an armchair FTO, just to do a quick patent search to make sure that you're not infringing on other patents. But if you've done some work there, we want to know about it. And then, other information about IP. So, IP, again, is one way to have that competitive advantage. Another way is being first to market. Another way is having a Rolodex of contacts, like we would invest in an entrepreneur. Maybe they have a real estate SaaS company, and they've been in real estate for 30 years, and they have, a Facebook following or an Instagram following of 300,000 people, and that's your competitive advantage that you can. In fact, I'm involved in sort of an Uber of solar, a kind of a high-tech solar company that the founder CEO was an expert in internet marketing and had hundreds of thousands of followers. And when he created the company, they all followed him, and it allowed the company to grow very, very quickly. When we invested, when the company was under $1 million in sales, they did $320 million last year. Okay, so continuing on, I'm not going to get into like the definition of patents versus trade secrets, but we'll ask about that. A trade secret is essentially something you're not pursuing a patent, but it's still, there's something about your product that's hard to replicate, and you're just maintaining it as a trade secret. One of the most famous trade secrets in the world is the recipe for Coca-Cola. They never patented it because they didn't want to disclose it. You have to disclose everything about your patent in a patent application publicly. And they decided it was better to just keep it in a vault with very few people knowing about it and keep it as a trade secret. We're going to want to know if there's anybody else who has claims on your IP. Maybe there's a inventor on the patent that's not currently in the company or who hasn't signed their rights to the company to own the IP. We want to make sure that's all taken care of because nothing's worse than doing everything right and funding your company and having you work really hard for 3 to 5, 7, 10 years. And you go to sell the company and you realize you don't own your IP and now somebody's holding you hostage before you can take your company public or sell it to a buyer. We want to know a little bit about regulatory. For a lot of your companies, this won't be applicable, but for instance, life science companies, we're going to dig in a bit about FDA approval and what that pathway is. And then if you're doing something else, maybe in the clean tech space, there might be electrical considerations or UL or other things we want to know about that. Then we're going to want to dig in a little bit on management and governance. Are you issuing stock options? If so, how is that pool broken down? We're going to want to know about your cap table. Cap table stands for your capitalization table, meaning, if you have a corporation, you've issued shares in the corporations or options to purchase shares in the corporation. And we're going to want to look at that cap table. And we're going to be looking for anomalies. We're going to be like, we expect the founder to have a meaningful equity stake in the company. If they don't, something's wrong. Maybe we thought they were the founder, but they're not. They came in later, and there's a lot of equity that went to people who aren't in the company anymore. Or maybe the company has already raised a small amount of money, but given away a lot of it. And that's a problem for us because we want you as founders to prosper from the company being successful, and nothing good comes from us investing in a founder who has 5% equity in the business at the starting line. When it's going to be diluted even further as you raise more money and as you issue more stock options. So we'll look at all of the details of the cap table and the option pool, how options are vested. We typically want to see options vested over time, typically 4 years, or based on milestones. Like if you bring in a chief operating officer, maybe they get a certain amount of their stock options vested when the company achieves a revenue milestone or some other milestone. We're going to want to know about your board of directors. If you're a very early stage company, you may not have a board of directors. If you take money from co-fund or new fund, you almost certainly will have a board of directors by the time that transaction closes. It's an important thing for governance. It also gives you very committed advisors and collaborators to help guide the company forward. If you have a board of directors, we're going to want to understand who are the independent directors, who are the founders, or what we call the common directors who have common shares, and then any investors that are involved in the company as well. Most early stage boards are not directly compensated. They might receive stock options, but we'll ask about that. Victoria earlier asked a question about advisors. We'll want to dig in on that a little bit. I don't know that we often actually do background checks, but we do ask if the founding team is willing to allow us to do a background check. We ask about employment agreements. That's important again for IP, and it's important just to make sure that if a person leaves the company, that they don't take things with them. We ask a little bit about insurance, if there's liability, key person, directors and officers insurance. We don't always recommend key person insurance. It tends to be fairly expensive. That's insurance. It's like a life insurance policy that if a person we deem to be instrumental or important to the company unfortunately dies, it pays the company a policy for that. And then directors and officers insurance you'll typically have after you set up your board. It basically covers the directors and officers in the event that they are sued in relationship to their activities with the company. We ask if there are any present or past members of our organization in the company. We're checking for conflicts. And conflicts aren't necessarily bad. We just want them to be disclosed. We ask about whether you have a lawyer, the company's corporate structure. So one thing important as you think about raising money is there's almost no venture fund that will invest in anything other than a C Corp. There's lots of reasons for that outside the scope of this meeting tonight. But it's worth noting that if you're an LLC or an S Corp or a sole proprietorship and you're planning to raise meaningful money, you'll almost certainly need to convert to a C Corp to do that. There's actually nothing wrong with an LLC. An LLC is actually a very tax advantaged business structure. It's just not good for investors because it's a pass-through entity, which means if I invest $100,000 in your LLC, you are now part of my taxes forever. You have to send me a K-1 form that I have to file with the IRS every year. If you retain earnings, I get taxed on the earnings, even if you haven't paid them to me. And so it's a little bit of a difficult structure to have passive investors in your company. We ask to make sure the tax returns have been filed if applicable. We want to know about your funding history, how much capital was invested previously. We want to know if the founders have put cash into their company. This is a trick one because so many founders will say, we've invested $1 million. And then when you kind of dig in and due diligence, they treat the sweat equity, the fact that they didn't take a salary as investment. And while I appreciate sweat equity, this question is really about, like, did you write a check that went into the bank for $100,000 or $10,000 or that sort of thing? We want to know if you've received financing before, if there are any anti-dilution provisions that we need to know about, because that could be dangerous to new investors. If old investors have certain provisions that allow them to preserve their stake, their pro rata, when others aren't, we want to know about that. We want to know about litigation, permits and licensing, did anybody give you a slap on the wrist for anything? Environmental issues, if you've ever solicited for funding under Regulation D, any of your members of the management team have committed a bad act as defined by the SEC. Of course not in this group. And then we were going to ask about the current deal terms, and that's probably the subject. I don't know, Amy, if you have another session on deal terms and how that works, but there's most of the time we're either investing in equity, meaning we're buying stock in your company. We're investing in what's called a convertible note, which is we loan you money. You pay us interest, which is deferred. And if you end up raising more money while that note is outstanding, we will automatically convert that note into equity in that venture round that you raise after you do the loan with us. And then a SAFE is an instrument that was actually created by Y Combinator, the most successful accelerator in the world based in the Bay Area. It stands for a simple agreement for future equity. And it's kind of like an IOU that says, when I find somebody to independently value my stock and they invest a meaningful amount of money, then this IOU will convert into stock on specific terms related to that round. We want to get your idea of what your company is worth. This is super important. So many founders will say, well, you're the professionals, you tell us. We want you to know what you're selling shares in your company to us. We want those shares to have an asking price. And it's okay for you to say, well, we're looking for 5 to 6 million, but we'll have a conversation with you if you think otherwise. You're allowed to kind of say those sorts of things. But we don't want to go down a path and do a bunch of work only to find out at the finish line that we're way far apart on what we think your company is worth and what you think your company is worth. Many, many, many of our deals that we are excited about never get off the starting line because the founder has a different, they might be a standard deviation away in what they expect from for the valuation of their company versus what we think it's worth. We want to know if there are any finder's fees or using a broker. Is any part of the money we give you, if we make $1 million investment in your company, is 100,000 of that leaving the company to pay a fee to somebody? We want to know that. Then we ask about your financials, if there are outside people involved in your financials. We want to know about any deferred expenses. So again, if we invest $1 million, we don't want to know that on day 2 after we've made the investment, that 300,000 was went to pay deferred salaries that hadn't been paid or to pay off a loan that we didn't know about. So we dig in to learn more about that. Then we just ask basic information about revenue, the run rate, the salaries. Salaries of management team are important to us because we don't want to just be funding somebody to have a job. We want you all to have, a meaningful, we want you to be taking risk alongside us. So most founders in early stage pre-venture capital companies, we expect that they're pulling below market salaries or sometimes no salaries out of the company until they get to a point where the company can sustain them a little bit more. if you have real estate, office leases, bank statements, and that's it. And then we have a couple of like check the box things that we do internally. We want to check your bank balance to know how much money is in the bank. We want to make sure there's a cap table. We'll do some quick Google searches around the management team to see if we find anything worth discussing, and other sorts of things. And that is our survey. It probably took longer for me to talk about it than for you to complete it.
Well, you were on time. So I actually, and I'm going to ask Patrick, I'm going to introduce Patrick in a minute here, how long it took him to fill that out, because I have to say, I'm feeling a little like overwhelmed. I don't know how the founders on the call are, or like anxiety, like, oh my gosh. But we'll ask Patrick the first time he saw that, how he felt and how long it took him to fill it out. So Dean, thank you for going through that, actually, because it's helpful to have someone explain each part of it to you rather than you kind of figuring out or assuming on your own what it's supposed to be there. So I think that was the most very helpful. So thank you so much, Dean.
Cool. And real quick, Bojan had a question, I hope I'm not mispronouncing your name, about, well, since VCs and most investors won't sign NDAs, how do we protect our IP during due diligence? So the short version on that is, you share with us anything that you can share with us that is public, or that you're comfortable sharing. If we need to dig in and look at a contract which is proprietary, or look at a patent application, sometimes what we'll do is assign one of our members to enter into an NDA with you to look at that, and then they'll speak on behalf of what they saw and say, I checked the IP and it's okay. So we're not opposed to signing an NDA when there's a legitimate reason to do so. We're not going to do it at the beginning of the process. And the main reason for that is we look at so many companies that we just don't want to have to litigate with you. Like if you have hotel software and you make us sign an NDA before we engage with you, and then we look at 3 other companies that have hotel software and we choose to invest in another one, it happens to be your idea. We don't want you suing us because there was an NDA when in reality, it had nothing to do. Like we just don't want to deal with that matter. It would be hard to talk to anybody if we had 2,000 NDAs that we'd previously executed.
No, thank you for that explanation, and I understand why you wouldn't sign an NDA. The question was really, the value of my company is the technology behind it, and for you to be convinced that it's a viable investment, I kind of have to share some of that secrets. And another guy pitching to you, or you could be having another portfolio company that you are advising, and you could say, hey, how about looking this way because these guys have made some progress. Or
no, it's a risk. It's a risk with all of our life science companies in particular. And I want to let Amy get back on track with the program, but it's something that it's a delicate balancing act because we need to understand the IP in order to make the investment. The reality is if it's based on patent filings, you're already first in line, and the patent will fully disclose the invention when it's issued anyway. So you do have that level of protection.
Thank you.
Yep. Thank you for that. And make sure do your due diligence on the investors so that if they seem like they're going to respect your IP, do your due diligence as well. So let's introduce Patrick Schmidley. Thank you for joining us, Patrick from Kari Health, who won SDAC 5. Yes.
Four.
4? 4. Okay. Awesome. Well, I'm so happy that you were able to join us. Patrick joined us earlier for an E-Track while he was presenting in Las Vegas. He made time for us. So we're so happy to have him back. So Patrick, tell us a little bit about, we all know what your technology, what you're developing, and then a little bit about your experience due diligence. And I want to know, when you saw that form, because I know you filled it out because you got investment from SDAC and New Fund, what was your impression and how long did it take?
Well, as I was listening to both Dean and JC go through everything on their slides, I was suffering from post-traumatic stress syndrome. I think I forgot how painful it was to go through it. But what I do want to say is that going through the SDAC experience definitely made it easier and faster to then go through the same process with New Fund and the Cove, because a lot of the information is similar. It's asked in different ways, and you have to provide it in different formats sometimes, and in a different context. But but it's really helpful when you go through the SDAC experience that that really prepares you and gives you a very solid foundation for any other due diligence process that you're going to go through with an angel fund. So anyway, do you want me to just share a little bit about our company and then talk through some of the due diligence processes that we've been through? Is that?
Yes, thank you.
Okay, so I'm just going to briefly, I think most of you have heard our pitch at one point or another. Can you see that okay? Hold on. No, it's not working. Let me see here.
There we go. Something's.
No, it's not letting me share. So I don't know, either somebody else is sharing or something's going on. Anyway, I can just talk to it. So
you want to email it to me and I'll share it?
it's okay. I'm just going to talk to it.
Okay.
And then we won't make everybody wait. So I'm Patrick. I'm the founder and CEO of Carry Health, and we're developing the problem that we're trying to solve is medication adherence. And to do that, we're developing a small wearable, about the size of a quarter, a monitor that is worn on the skin and detects medication levels in the interstitial fluid in real time. So you can think about it kind of like a continuous glucose monitor, but instead of glucose, we're monitoring medication levels. And we do have the ability to measure several medications, many medications, but we're proving the platform capability first with a medication called methadone, which is used to treat opioid addiction. Why opioid addiction? One, because I had a close family member that struggled with opioids, so I have a passion about making a difference there. But secondly, most importantly, is that the rise of illicit fentanyl has made the need for new solutions very urgent. And since our family experienced this opioid crisis, it's gotten much, much worse due to the rise of illicit fentanyl. When somebody's addicted to fentanyl, it's basically they have few options left. One of them is methadone treatment. And unfortunately, there are two major challenges with methadone treatment. It's otherwise a very safe and efficacious medication. But one, it takes too long to get to a therapeutic dose. And then two, when patients do get to a therapeutic dose, they then have to go to a clinic every day in order to demonstrate compliance and get their medication. Those two factors cause high dropout rates, patients falling out of treatment, going back to using fentanyl, and basically overdosing, landing in the ER. So needless to say, all those patients that have decided to leave the cycle of addiction and lead a better life, they keep getting pulled back because it's just so difficult to stay in treatment. So that's how so we invented this quarter-sized monitor that helps clinicians with titrating patients to the right dose quickly and safely. And then once patients are at a therapeutic dose, they can use our monitor to demonstrate compliance remotely. So that increases treatment retention rates, helps patients escape the vicious cycle of fentanyl addiction. So that's sort of our solution at a high level, sort of 2-minute pitch for everybody to have the background. And because of sort of the tremendous potential of our solution, not just for methadone, but also for other medications, we've been fairly successful in raising quite a bit of funding. And so we're very proud of portfolio members, one of SDAC, but then also of New Fund, as well as the co-fund. And been through the due diligence processes that Dean and JC described and Amy referenced, and so I can talk a little bit about sort of the nuances of each, but I'd really like to just open it up to questions and see what questions all of you may have that I can respond to and answer. But at a high level, SDAC, the way it works is that if you're planning on participating in SDAC, there are many new investors. So there's some seasoned investors that have been part of many SDACs, and they're very seasoned and experienced in evaluating companies. But really, one of the core values of SDAC is to educate new investors. And so, if you think about that, right, because it's overwhelming as you go through the process, because you have to fill out all this information, you have to respond to requests, and all you're worried, all you can think about is meeting deadlines and pitching and preparing for the pitching. But really, if you can also think about what can I do to help educate these additional investors, that is going to go a long ways and helps you build relationships. And think about finding champions that really that can identify with what you're working on, either on a personal or professional level, and develop and build those relationships. Because regardless of which fund that you're working with, at the end of the day, you know, when the camera goes off and the investors go in the back room and talk about, okay, are we going to move forward or are we not? You really want to have advocates that believe in you, that believe in your company, that believe in your technology, that will, because there's a million reasons why someone is not going to invest in a startup, right? Let's face it, there's a lot of risk, and you really need to have champions that speak on your behalf and that'll say, okay, well, yeah, understand that's a risk. You know, every company has a risk, but I really believe in this team because I believe that they can overcome that risk. They've proven to be resilient because I've seen it here and I've seen it there, and therefore I think they're going to be able to overcome these challenges. So it's really, really important that you build those champions. So I'm just going to pause here for a second. And first, thank you, Dean and JC and Amy and Miss Dean team for the support. And yeah, happy to answer any questions.
Yeah, so we do have, yeah, well, do you remember how long it took you to fill out that form?
Well, you know, quite some time in the beginning, you know, first when we first participated in SDAC, we had just formed our C Corp. We had just pivoted to a new platform, pivoted to a new application. So it was, you know, it was fairly at the very beginning of our new direction. And so it took us quite a while to fill out the original form. Once we went through SDAC, then, you know, we were able to use a lot of that material to then submit the same similar information to new fund. But, you know, it probably took a few hours, if I recall correctly. And then, you know, I needed to involve my team, make sure that it's reflective of our, you know, because once you go through due diligence, it's not just the CEO and the founder, it's the team. And you want to make sure that your answers are consistent. And so you want to make sure that everybody's involved in the process.
All right, well, I have questions, everyone has questions. So we're going to move into the Q&A, I guess, with the moderation. So it's kind of free form. I have questions, I know you guys do. So if you want to ask a question, the best thing is just put it in, or is to raise your digital hand, because then you'll pop up to the screen and then I can call on you, like Jordan from Wind and Sea Coffee. So go ahead, Jordan, go ahead and unmute and you can go ahead and ask your question.
Hey, Patrick, thank you. Yeah, my question was, so I'm definitely interested in seeking funding, but San Diego, SDAC, new fund, veteran fund, a lot of these, I don't know that my company necessarily fits the criteria for the type of company that they would necessarily be looking to invest in. I'm still seeing the value in doing SDAC, so that's my plan. But I guess my question is, talking about champions and finding people that can connect you to other things, how can you sort of like roadmap for me what that looks like? You know, so you pitch, hey, thanks, you know, sorry, runner up, didn't quite invest, but what is the next step towards finding these champions and getting connected with other people that can open some doors for you? What does that look like? Thank you.
Well, I'm not sure there's a roadmap for that. I think the one thing I would say is go to every single event that you can, meet people in person, find out about their passions and whether or not that aligns with what you're working on. And that's really sort of the starting point. And these particular events, I mean, what I used to do is I used to take screenshots of all the names that were on Zoom, and then I would then follow up and reach out either via LinkedIn or email if I would have access to their email addresses, and see if you know, if they had any questions based on what I just presented, and started to build a relationship that way. When we were going through SDAC, I was fortunate because actually it just happened to be that one of my kids was playing on a flag football team, and two of the SDAC investors, their son was playing on the same flag football team, and so, you know, so I was able to build a relationship with them sort of at the beginning of the contest, and was able to then build a network, if you will, of folks within the SDAC that then, once it came time to evaluating which company I were going to move forward with, the more people knew us, right, and they knew us on a personal level. So that was really helpful. Sometimes you have to be lucky, but you also have to be very thoughtful and deliberate about wanting to build those relationships and going to the events and investing the time, effort, and energy to do that.
Yeah, that kind of brings up the sort of old cliche that, like, you have to be really lucky to succeed at entrepreneurship, but those who do more work tend to be luckier. Like, they just put themselves into more positions for things to happen. And very quickly, Jordan, can you give us the 15-second elevator pitch on your company?
Yeah, so my company's called Win and See Coffee. We do adaptogen infused coffee and coffee products, just improving the coffee experience.
Yeah, so so the best way to proceed there is in the industry, like, is to connect with anybody you can who has been down a similar journey of what you're looking to go down. And then there's another. I'm going to keep throwing the cliches and the old adages. And there's another adage where, like, it's kind of well known to entrepreneurs: if you're seeking funding, ask for advice. If you're seeking advice, ask for funding. And so so just fun fact is, one of the most recent new fund investors is a company called Talitha Coffee. That was a company that has no intellectual property, no aspirations for intellectual property, but has a killer management team that's an expert at private equity roll-ups, and they have a business plan to acquire small coffee roasters and small independent local coffee roasters, roll them up into a national B2B brand, and it's not even tech. But we've bet on that team, and their competitive advantage was that they've done this in other industries, and they were passionate about doing it for coffee, and that's what we do.
Yeah, that's exactly like those types of companies. Like, hey, we acquired X and Y business, and we're building a portfolio of when we the LVMH of adaptation. But I just don't know what they are or where to find them. But that's exactly
If you want to reach out to me, deanrosenberg@gmail.com, I'll connect you with Talitha at least, and that's just another contact.
I appreciate that. Thank you.
Great.
It's already working, putting himself out there. He's asking the right questions.
There you go.
There you go. That's
job, Jordan.
questions. Put yourself out in front of everybody else. Yeah, go ahead. I think
We have a question from Drew Colton.
Hi, thank you guys so much for your time. I really appreciate it. Just piggybacking off what Jordan just said, I was wondering if there's any events that are coming up in the near future that you guys would recommend attending for angel investor, or for Jordan and myself, really ready to go, seeking funding from an angel investor. I'm really ready to go to find that person or persons. Are there any events you recommend going to in the near future?
I would say the end of this year is kind of winding down, so I'm not sure there's anything new coming up, but I know in the new year there'll be a ton, and it just depends what industry you're in. Not sure. It might be helpful just to give yourself a 15-minute or 15-second kind of overview on what you're doing. But I would say look at a lot of the organizations. I have a good resource list I can send you. I can share with Amy, who can distribute that out to all of the attendees. It's got the Octanes, it's got Connect down in San Diego, it's got the Alliance for SoCal up in LA, and they have newsletters every month or almost every other week that they send out showcasing what's happening in the area. New events, pitch demo days, accelerators, meetup groups for coffee and whatever. So I can share that with you or with Amy, who can distribute that as well.
Yeah.
But nothing comes off the top of my head.
Yeah, I would love that.
Evanexis is another one.
Mm-hmm.
Neil Bloom, he does a founders walk every month at Torrey Pines. So there's lots of different things.
And getting connected at the.
Sorry. I was gonna say, like, I saw that on Neil's LinkedIn. Am I allowed to go that? Like, to show up there?
Yeah.
Yes.
Show up.
Yep.
Oh, I didn't know if it was founders. I thought it meant like other angel investors.
No, founders are you. Founders are you.
Thank you. So, okay.
Neil also does investor events. But yeah, that founders hike is for people who are entrepreneurs to just chat with each other and share ideas and get some exercise. Yeah.
Okay, wonderful. I'm so glad you guys mentioned that. Thank you.
Yeah, I would. So that ecosystem slide that we had up, those are like all the nonprofit entrepreneur supporting groups, and they all have events to support an investor or to support founders, and maybe they'll have a pitch event. So once you start attending the events, every organization has just a little bit of flavor to themselves, and you'll find like where you fit, or maybe you want to go to all of them and you'll see some of the same people. You'll find like every time you come to E-Track, we know who you are, we've seen you, and the cohort that comes to every event.
Yeah.
So definitely like get on their newsletters or follow them on LinkedIn. And the more events you go to, the more you start really knowing people in the ecosystem.
Okay, great. Thank you so much. JC, did you want me to tell you what I did real quick, or do we not have time for that? Or should I?
I'll defer to Amy for that.
Oh,
Let's
okay,
hear it.
thank you.
Let's
All
hear
right,
like 1 minute pitch, Drew.
go for it. You giving it to me to do it?
Yep, let's hear it.
Okay. All right. Thank you. I'm the inventor of a company. My product is called Lightning Drums. It fires bright, explosive, beautiful flashes of neon, colorful lightning in the interior of clear acrylic drum shells to the rhythm and beat that a drummer is playing in real time. And color options are red, orange, yellow, green, blue, purple, and white lightning. And I'm seeking an investor for a $370,000 investment for 12.5% in ownership of my company. And I have real traction, and I'm working towards obtaining an exclusive patent licensing agreement with a major drum company called DW Drums. And
So-
I give all glory to God for my invitation.
So very, very quickly, Drew, again, if you want to reach out to me, I can connect you. Sounds like a great Shark Tank deal, and I'm actually serious. I've worked with 5 companies that have been on Shark Tank.
Let's go.
And then also there's a very successful guy in town, used to be a lawyer. He's created now CRE guitars. It's a foldable guitar used by professionals.
Yeah,
He may be able to connect you into that space too, and I can connect you with him as well.
that would be amazing. I would love that. God bless you. Thank you. Can I please grab your email?
Dean Rosenberg at gmail.com. BERG.
Okay.
I think it's misspelled in the slide deck, but it's BERG. Yeah.
BERG is the Dean Rosenberg.
Yeah. Maybe Amy
Okay.
can distribute later, or we'll figure that
Or
out.
Steven,
Yeah.
Thank
Steven
you
put it
so
in
much. That's a blessing. Thank you.
Yeah. Here, I'll put it in the.
So thank you, Drew. So I was going to ask a question about the 20 to 30x return. How can founders showcase that? How do you evaluate that?
Yeah, that's for me. So what we look at is the revenue, the market size, the revenue potential, their go-to-market strategy that reflects that. And then, all the subsequent funding rounds, we do an analysis of the cap table, the future funding rounds, that how much dilution we'll get to. And then when that liquidity event happens, is it going to be, if their revenue potentials, 30 to 50 million or north of that, and they get acquired for, 200 million or more, that'll hit hopefully our 20 to 30x multiple. And it is about us, buying in at the right valuation as well. So there's a lot of that is in play. So it's a lot of factors that we do, and we have a kind of an analysis tool that we use. So I can certainly share that with you as well.
And just to double down on what JC is saying on the valuation front, we originally pitched to the Cove. I think it was in sort of the February timeframe, and essentially the feedback we received was, look, we love everything you're doing, we love your team, we love your technology, but your valuation is too high. Come back when you're ready to talk at a better price. And so then once we went through SDAC and got funded by New Fund, and we had a deal in place, we were able to go to the Cove. The terms were more favorable, more in alignment with what they were looking for. And just to give you a sense, typically, so we built a pretty extensive financial model that's well thought out, and has you have the ability to just plan out different scenarios in the model. And typically, so we've been through, I think, 7 successful due diligence processes. We've been through more than that because some of them were not successful, but typically what I do with the financial models, I walk people through it and kind of give them the background, and then if they want it, then I'll send it to them. And with the Cove, it was very different. Mike just said, I don't need you to walk me through, just send me the model. And
Yeah.
and so and then Mike did his magic and he came back and said, okay, this is going to work for us. So so it's just really important you have a thoughtful financial model that supports the story that you've articulated in your slide deck, that will lead to the potential exit that the Cove is looking for. And it's actually something that I use pretty frequently in my pitches, is that how many deals the Cove has looked at, how many of those they invested in, we're one of the few they invested in, and then what the return of investment is that they're looking for, because that is some level of evidence that somebody else has looked at our deal and thinks that it could have that kind of a return on investment. So I hope that helps a little bit.
Wonderful. Thank you, Patrick. And then just the platform, marketplaces that you could tap into too, Patrick, was another key aspect that we looked at in terms of hitting our multiple. But yeah, there's a lot of different factors that we take into consideration when we're looking at a deal. And Patrick and I did the math today. We looked at, north of 1,600 deals, and we've invested in 7. So what was the number we came down to? It was like 0.5%.
It's very small. Yeah. I was very humbled. And felt very fortunate. So
Okay, well, I was going to add, I'll save we'll go back to the questions from the audience, and then I'll come back and ask some of the moderating questions. Oh yeah, you guys raise your digital hand, it'll put you at the top and I can see you and call on you. So we'll go with Garrett. Go ahead and ask your question.
Hi, thank you, Amy. I had a question about cold approaching on LinkedIn. LinkedIn's a great place to meet investors, I gather. I mean, Patrick, I imagine you probably had some experience with it, but do you guys have any opinions as like an investor or insight for what works, what doesn't, any insight there?
I probably get 10 to 20 inbound messages a day on LinkedIn alone from new startups. The problem with LinkedIn is that a lot of these startups aren't doing their homework before. And so my first slide, as I mentioned in my deck, was make sure it's a fit. Do your research on the fund. Don't just, blast. I mean, it's fine for you if you blast, but I, immediately disregard, because I will look at the company and the profile of that individual and go, oh, they're based in the East Coast, or they're based in, Europe or wherever. I get them internationally and I'm like, it's not a fit. So make sure you do your homework, have a methodical approach, have a nice, maybe tie something in like, this is what we're doing. I've seen that you have a portfolio company that's doing the same, or something like that. Have a really methodical approach that's compelling and will pique the interest of that potential investor. So make sure there's alignment there. But yeah, LinkedIn's a great tool. I get a ton of deals, and ones that I, set up calls with to have follow-on discussions with if they're a fit.
Yeah, it's always better to do the work and have it be a soft, a warmer call than a cold call. And it's often not that hard to do that. Like I raised money for a VC-backed venture many years ago, and we raised $30 million ultimately, but we literally architected 2 of the partners meeting at the water cooler in their firm. And one brought up our company and the other one said, oh, I just heard from this lawyer about this company. And we actually created buzz just by doing that. It took a lot of work, but had we just sent them a LinkedIn, this was Kleiner Perkins, one of the largest VC firms in the world, they would have just ignored it.
Mm-hmm.
Right.
Yeah, I have not had a lot of success with cold reach outs. So to the extent that you can reach out to people that have been at the same event, for example, or where you at least saw them on Zoom, I think you have a better chance of success. But cold reach outs without alignment is not necessarily productive from my perspective.
Yep.
Warm intros are much better. Yeah.
Thank you for that. Okay, we have a question from Ravi. Go ahead and unmute yourself.
Hi, thank you, Amy. My question was inspired by you because I think I was so puzzled that everybody keeps on saying 20 to 40x. So I'm gonna ask my questions on the 20 to 40x. So I think JC, you mentioned that you see the financial models, how much it can be exited at eventually. but let's say if you're not there yet. So how do you start establishing a valuation for yourself so that it's not too high? Could you also elaborate on that, and at what stages do you do it? Maybe it's a naive question, but I think I've heard this enough that I think I don't know the answer to this question, and I want to learn.
Well, we're investing like, a lot of angel groups very early. So we hope, and Dean did a great job understanding, we're going to invest in about 20, maybe 25 portfolio companies with this third fund. And our math is very similar. Half of them may not make it to the next round. They may fizzle out. The other half is going to maybe have some progress, make another round. And then probably, half of that will have significant traction. And then hopefully, 2 to 4 will be home runs and we'll make up our whole fund. So it's just the way our fund is constructed. So when we're looking at a deal, it's understanding, okay, if we buy in at this price in terms of valuation at pre-money, and we see, multiple, or if the buyout is, north of 200, 250 million, or north of that, we have potential to hit that expectation of, 20 to 30x or even more. So that's kind of our high level math, if you will, on how we understand a deal and what we're looking for initially. And, as Dean mentioned, I love lifestyle companies personally. I think they're great. They can really do wonders for you and your family and everyone that you support. And you can, it's all about hiring the right people and, bolstering the economy. That's the bread and butter of America. Venture funding may not be the best, investor for a lot of startups. So it is challenging. I've been in the shoes that, some of you are in, where you're challenged with who's the right investor. You got to kiss a lot of frogs, as they say, to find the prince or find the investor. And I'll put myself in your shoes. For our fund, we had to do the same thing all of you are doing to raise our fund. We had to go out to our LPs. We had to sell them on what we're doing, what our unique value proposition is compared to other funds. They have to do their diligence on us as managers and our expertise, and then how we're going to perform. So I know it's maybe a more long-winded question and maybe not direct to your specific answer. Hopefully I answered that a little bit, or framed it.
I think I got the answer at your end, but my other question was, how do you decide, and at what stage does a startup decide what its valuation, so that it doesn't get into the issue that Patrick mentioned, that maybe early on you set up too high of your value? At what step does one need to do it? If you can help me understand
That's
well, Dean and JC, correct me if I'm wrong, but at this stage, you guys, in terms of the deal flow that you're seeing, any startup that has a valuation north of 10 million is not something that you're even going to look at. Is that a fair
That's a fair assessment. It depends on how much they're raising as well. So that's one factor. And then the other factor is what milestones, or maybe they have some incremental revenue. But I will say, on average, you're right, Patrick. We're looking at 5 to maybe 15 in terms of the pre-money. Very rarely, we have not done a deal with this third fund north of 15 as a pre.
We invest in higher pre-monies, but they're further along. And so that's the, I'd say our sweet spot. Ashok Kamal would probably have a better read on exactly what our median is. I'd say our median is probably 10 million-ish, but that reflects later stage deals. We did a deal 2 years ago that was a 200 million pre in new fund. Very, very unusual, but we did it.
Can you speak to the stage of a company? Like, we have some people are just ideas, some of them are proof of concept. Where's kind of the sweet spot that each of the funds is looking for?
You want to give that a shot, JC?
Sure. Yeah. So in terms of where us as a fund, we are looking at seed stage. So I know, again, that's a moving target, but companies raising really their first institutional round. So hopefully you're not writing your idea on the back of a napkin saying, here's my great idea. It's more if you have a team established. It's not just a solo founder. We're usually looking for 2, if not 3, kind of co-founders together, or a good one CEO and a couple kind of co-founders behind them. Also have hopefully a proof of concept, some sort of working prototype. Hopefully you've got some early customer validation as well, or maybe you've kind of started to slowly approach the FDA in terms of a life science company. So that's kind of where we fit. You understand the market, and you understand the market potential and your unique solution to that, and you're solving a unique problem. So those are kind of the high level check boxes that I look for when I'm assessing a deal. And our companies, again, our sweet spot, our average ask in terms of companies are raising 2 to 3 million. We have the range of 1 to 5, but it's really our sweet spot's the 2 to 3. So we're not, they've got friends and family. They've maybe got an angel round behind them. They're ready to really kind of go to the next level. So that's where we step in. So
and we're a little bit different. We're happy to invest in a single founder. We're happy to invest in an idea on a napkin. The valuation will reflect that. The challenge we have is many ideas on a napkin the founder thinks are worth more than they are at the napkin stage. But we have no sort of preset rules there. With that said, the sweet spot would be you have brought a minimum viable product to market and you have attracted your first customer. I'm not talking about life science. I'm not talking about hard tech where there's more science to do and such. But if it's a SaaS software company, if it's a mobile app, if it's a product where we believe you should have been able to make some progress to get to a minimum viable product and demonstrated the ability to extract a check or a credit card or cash from a customer, we are going to like you a lot more because you've de-risked a good part of the business and you've proven your ability to perform.
Yeah, just to give you a sense, so this morning, the Cove had their portfolio companies of the third fund there. There were 7 companies, and of the 7 companies, 6 companies already, they were talking about revenues, and we're the only company that's a pre-revenue company, right? So if you are a life science company and your path to market is longer, your chances of getting funded are the level of scrutiny is that much higher if you're a life science company and you don't already have product market fit and you already have traction in the market. It's that much more difficult to raise funding.
It is, but and thank you, Patrick. But that also brings a great point. I think we invested after you had received some grants as well, right? So you had some validation from outside parties like NIH and SBIR that validated you've done something.
Yeah, I mean, we used other ways to validate that we're headed on the right path, but it's still very different developing a life science product and solution than it is if you have a SaaS product or an app. Yeah, so you have to get very creative in terms of demonstrating that if you build it, they will come and pay for it.
And JC, you mentioned raising $2 million. What is the kind of runway that you expect that to last?
On average, a year to 18 months. If you can extend that to 24 months, even better. If you can be more lean and mean, but on average, it's somewhere between the year to 18 months. And the saying goes, once you close this round, then you wake up the next morning and you start fundraising for your next round. So you'll always be raising. So it never stops. So I have plenty of empathy and sympathy for all of you out there looking to fundraise. It's hard work and it's grueling and it's a lot of rejection. So you have to have a lot of thick skin. But you will find your capital investors eventually. You just got to put in the work and put yourself out there.
Mm-hmm. All right. And I was going to ask something. I guess I'll have to defer to Jeff while I remember what my question was. Go ahead, Jeff.
I had a question about kind of having a mindset of your exit strategy and, kind of setting up from the beginning, thinking about your exit. And I've always been curious about that. I think that it's important to have an exit strategy or be mindful of like your valuation and what your company's worth. But I was curious, like from the investor perspective, if your company, let's say an investor comes in and your company, they invested when your company was at $10 million valuation, and then your company goes to 30 million, 50 million, 100 million. Is it simple for that investor to get out and get their return, even if the company doesn't get bought or doesn't do a merger or doesn't do an IPO? Is it simple in today's investment world where, like, if we had that much of a jump in the valuation where somebody who was in earlier, wouldn't the company I'm curious if the company would just be like, yeah, we'll buy you out, and then the investor can get out, and the company doesn't necessarily have to exit for the investors to be happy. I was kind of curious about that, what's going on related to that conversation.
Yeah, so maybe I'll take that. So when you receive outside investment from sophisticated investors, there are all sort of what are called protective provisions that give the investor quite a bit of control over whether they get bought out or not. And we talked a little bit earlier about a board of directors. You know, if an investor is investing in a company, the company is growing in value and they don't see an exit on the horizon, they can get cranky. And that can cause, you know, if they have a board seat, that can cause dialogue at the board level. In extreme cases, it can cause rifts with the CEO, even if they're the founder. And, you know, it's not uncommon for CEOs to end up ultimately leaving a company, either voluntarily or involuntarily. And so, like, I had that in my company. You know, at the end of the day, my investors in the company I brought to New Fund made 7 times their money, which wasn't a bad return. It wasn't 20 to 30, but I didn't go out of business. They earned a good return. But it took 7 years. And, you know, at 5 or 6 years, they were sort of, you know, there was grumblings. And, you know, I had completely I raised just from angels. So fortunately, no one had like a whole lot of like leverage on their own. So, you know, and the company I'm involved in now, you know, has raised about $11 million, and they've been around for 10 plus years. And, you know, the company's still doing it. But yeah, it's an issue. And it's, you know, imagine Uber and Airbnb and how many opportunities there were for investors to get their money out. And they just kept, you know, I think Uber raised $16 billion in outside funding. Airbnb raised $8 billion in outside funding. I might have those numbers slightly wrong, but, you know, they could have sold for $1 billion years earlier and everybody would have been rich, and they didn't. They just kept in it for the long haul.
They kept in it. Okay.
Yeah.
So you're saying it's still, you can get your money out, but it's kind of like maybe somebody doesn't want to buy you out, or people.
Well, it's not easy to get your money out as an early stage investor. So even VCs can't. It's not like very few venture capitalists or angels do an investment that has what's called a put option on it, which says, you know, we have the right to ask you to buy us out in 5 years. That doesn't typically happen in early stage venture. So it typically happens more like, you know, more directly around like, well, if this leadership team is not going to get us to an exit and we think the time is right, then we need to start having more engaged conversations about, is there a leadership team that can get us to an exit? Because there might be a founder who's just perfectly likes the salary, he likes what he's doing, and you know, we've had founders that they want to make a dent in the universe, and the investors want to make a buck, and sometimes that doesn't align.
Right. Exactly. Okay.
And maybe this is a good time to bring up the term zombie.
Well, that's I mean, Jeff brought up the case of invested for 10 million, then it was worth 20 and 30 and 50. So I wouldn't put zombies in that category, but we do have, you know, we do quite often have companies where, you know, they're not quite going out of business, but there's almost no scenario that they're going to be successful. And now you have investors, particularly if they're on the board, that are like consuming time with a company that's like stuck at $1 million in revenue, or stuck always needing to raise extra money. And I saw something on LinkedIn. I don't remember who posted it. It might have been Ian from Gray, I'm forgetting the VC firm, Greylock. But he said he had like this thing, 5 reasons or 5 ways you know that your startup is failing. And one of the 5 things was your VCs no longer care about your company. And so like that's a zombie is like we also call them Walking Dead. You know, it's like they're not like they're still going along too much to fail, but they'll never be successful.
Yep. All right. Thank you. Thank you for indulging in that. Okay, so we have a question from Malte. Go ahead and unmute yourself.
Yes, absolutely. Thanks so much. Thanks for the great expert round. Also great to see a few familiar faces. Question is towards more like foreign investment. Is there like something you guys look in foreign investment? Everyone's talking about more diversifying investment to different markets. Is that something on a seed stage anyone is touching at all, or does it have to be a US company going particular towards South America, seeing a lot of traction, seeing a lot of great startups there with the end goal of the US market in mind? Is that something you guys looking at all, or is that something it has to be a US entity, otherwise it's too much risk in the due diligence process?
I'll start first because mine's easy. Maybe I'll turn it over to Dean. You can expand on this. But for our fund, we only look at SoCal. I do see deals that are from, Latin America or Europe or the Middle East that are interesting, but I'm only looking at it to get a kind of competitive analysis, understanding the market and what else is emerging, but not a fit for our fund.
Yeah, so at New Fund, so our fund investments can only invest in US-based C Corps, and the main reason for that is we're a relatively small fund, and we just don't know how to do the legal for a foreign investment. It's just not, we don't know how to protect our rights on a non-US investment. But with that said, we have a number of members at New Fund that routinely invest out of the US, and we routinely circulate. We're looking at a deal in Israel, we were looking at a deal in South Africa. Serhat Paula, who is the incoming New Fund president, has a very active fund personally that invests outside of the US. So it's, it's certainly not out of the question.
Cross Ocean Ventures is the name of it.
Cross Ocean.
All right. Okay. So we have another question from Byron.
Yeah, hi. I just wanted to go back to the SBIR grant funding. So I'm in aerospace, which is also a kind of a long road to revenue. And that's what we're doing, is pursuing the SBIR, STTR funding. I guess the two questions I had is, one is that on some of the agencies will actually match outside investment. So I was wondering how attractive that looks, or if you even consider it. And I guess the second is that, SBIRs are kind of slow moving. So you could, in theory, keep chasing that money forever, but it also means you're going to take a while to get to make progress, right? Because it takes quite a while to get the money, and then they last for several years. So I guess, do you expect people to keep chasing after the SBIR money, or just to switch over to private investment, or is it sort of TBD or situation dependent?
We do it when there's extra non-dilutive funding that's going to match our investment. So it's a big plus if you do get it, or if you're going down the path to get it, and the different phases that come with it. So it is a bonus and something we take in consideration. That's a plus.
Yeah, there's no question. I mean, this is a session, a lot of questions coming up. This is a session on due diligence, and there's no question that your ability to attract non-dilutive funding is a plus in due diligence. With that said, SBIRs are not a way to primarily fund your company for the reasons you mentioned. They take way too long, and they're too little amount of money. So it's something you do in parallel. And then the other risk is you don't want to be branded as sort of the government contractor type. You don't want to be branded as, you're actually not releasing a new, product or innovation into aerospace. You're a government contractor that's just chasing the next grant. So I personally don't have I don't have a mental model of a lot of companies, non-life science companies that were successful in pursuing meaningful venture off of the heels of a long-term SBIR strategy. I mean, having an SBIR going to phase 2 is awesome. But at the end of the day, you want to ultimately attract, money that is excited about the commercial opportunity for the product.
Yeah, I would echo that. For us, it would have been very difficult to get any venture funding without the SBIR funding. So it was a great foundation for us and validation. That was clinical, it was scientific, and it was from the space. And we just won another SBIR grant, but it was sizable. It was 2.8 million, and it's in direct alignment with our product strategy. So it's basically supportive of our product development efforts and our pivotal study. So if you're going to pursue that strategy, make sure that it's in alignment and supportive of your your overall company and product strategy. So it's not diverting your efforts and diluting your efforts.
Yeah, I'll just add, the non-dilutive funding really helps you get off the ground, especially the early kind of research that you need to do. And investors would rather you spend that money to do that kind of work than their money in general. I heard directly from Chris Garabedian from Exontogeny. But I do know some researchers who sort of, and either by choice, kind of run their business off the government, doing life science, drug discovery, and you can renew your grant every year. But I did have a client as my consultant job I had before I worked at the Brink. And he had developed, it was an SBR grant to like isolate DNA from gram-positive bacteria. So it was anthrax and things like that. So he was trying to commercialize it because he was trying to get away from the SBIR and the government funding. But every time we tried to meet with him, he had grant work to do. So he was kind of caught in this cycle where he was kind of at the mercy of his grants, but he was trying to commercialize the technology and just couldn't find a balance of his time. I see Patrick shaking your head.
Yeah, it's really important that it's in alignment with where you're headed anyway. So you got to be very thoughtful.
Yeah. So I was going to ask a question about being a lead. I think JC, you had mentioned that the co-fund prefers to lead, and maybe we should explain what a lead is. And then if you're not a lead, is that still a possibility?
Yeah. So to clarify, we don't mind being the lead. It's not mandatory for us to be the lead. Just to clarify what the lead means is that we're going to set terms, valuation, whether that's a price round or a convertible note, but primarily a price round. We're going to set, valuation and all of that's behind it. So it's not mandatory for us to be a lead. We're happy to follow along or co-lead. We've done some co-leads with New Fund, I believe, in the past. So hopefully that answers your question. But in terms of what that means is, again, just making sure that we're setting the expectation on valuation. So you'll probably, as a lot of you will go out there and talking to other investors, they'll go to you and say, hey, I really like what you're doing. Once you find a lead, I'll invest. You'll probably hear that a lot, unfortunately. So that's why we don't mind stepping in and stepping up to the plate and saying, hey, and our diligence process is very thorough, as Patrick can attest to. And we're happy to share our diligence notes, being the lead with other potential investors that are happy to follow along.
Mm-hmm. And Patrick, you was SDAC was your first investor and the lead?
Correct. So, and that was new for SDAC, I believe, to lead the deal. And so that the combination of the SDAC due diligence notes as well as the Cove due diligence notes were critical for us to be able to fill out our round. Because it gave other investors the confidence that somebody else had done the homework and the due diligence. And so we now have a total of 7 funds that have invested and I think 23 individual investors. So in total, I haven't added up all the members from the different funds, but with 300 new fund and 100 there's about 100 right in the co-fund, JC.
Yeah, just shy of 100, like 92, 93.
Yeah. So there are a lot, a lot of people that have looked at all aspects of our company and some with expertise in various areas and have chosen to come on the journey with us. So and the more people that you have that have done their homework and have written a check, the more helpful it is for others to say, okay, well, that means that there's something there and I want to be part of it.
And Dean, with New Fund, doesn't tend to prefer to lead. Is that still the case?
No, we don't. I mean, I would say most investments we make, we don't lead. Leading requires us getting involved in the legal and other things. But we'll do either one. We do have some rules in our fund that if we don't have a New Fund member on the board, we invest a smaller amount out of our fund. So we tend to invest more out of our fund if we lead the deal, or if we have board representation in the company.
And typically, when a fund does due diligence, they will draft a report their due diligence report, and then that's shared in a, I think it's the treaty with another fund who might be interested in. But the founder never sees the report, right? Patrick, have you ever seen your due diligence reports?
Not officially.
We had a founder who was editing the report, and I'm like, that's fine.
You can do that. Yeah.
And you're not supposed to edit it. Like,
No, but it's really, really valuable for a startup to have that lead and be able to go and syndicate that deal. Because then it's much simpler to say, okay, here's our company, here's the price. Is this something that you want to be part of or not? And then, you know, if not, then you move on. If yes, then you can add to it. And it just simplifies everything. Because you're going to hear, I can't tell you how many times I've heard, well, you know, we like what you're doing, but, you know, we don't, you know, we want to see you have a lead and we'll follow. Come back when you have a lead. You'll hear that over and over and over and over again. So
and venture is a very tipping point business, right? It's like nobody's interested, and then suddenly everybody's interested, because then it turns into fear of missing out, but it takes a lot of work to get there.
Yeah,
Absolutely.
but certainly the three funds that are on this call, if you can get traction with these three funds, they're very well respected in the angel investment community, and it really does mean something. So I would encourage all of you to certainly participate in SDAC, and if there's a fit for a new fund and Cove, to go through the process. Even if they don't invest, you're going to learn something about your company. You're going to learn about, you know, what do you need to address, what risks you need to mitigate to be successful with other funds.
and tell me about the data room or the deal room. Do you should a founder come with a link to their Google Drive, or do you have folders you want them to populate? JC, tell us how you guys organize that.
So we have a Dropbox that we share and distribute with all of our participating diligence team. So we extract everything from maybe, you know, that person's Google Drive or their own, you know, data room that they have. We'll keep static files that we'll then incorporate into our own data room. So we keep it stagnant so they can't change it or anything like that. But we'll share it internally. We don't, you know, share it externally, only with the diligence team. So yes, if as you saw my presentation, it's really all of those slides that you have in your pitch deck that support the diligence documents. That's really what we're looking for. You don't have to have all of them. If you have half of them, that's fine. We'll maybe ask you for certain things to go work on. But yeah, we'd like to take a deeper dive if we get to that diligence point to really, unpack all of those things, those key findings, and have further discussions through them. So yeah, if you have a data room set up or you're starting to build it out, it's really simple. It's just like your checklist for your pitch deck. Just make sure you're incorporating those same things that have more details and substance behind it.
And Dean?
Yeah, I don't think I have anything further to add. I think JC covered it.
New fund operates the same way.
Yeah. I mean, before we do the due diligence kickoff meeting, we will want the deal room to be available, and we will check for very specific things where we won't want to start the meeting without it. Like we'll want to see the cap table. We'll want to see, some key documents.
And just from a startup perspective, so we didn't have a deal room set up when we started SDAC, but SDAC was kind enough to share their deal room with I think the initial two funds that did due diligence on us. But now we have one set up in Carta, and I would highly recommend that you do that sooner rather than later. Have it there, because then you can also see who's looking at your documents, which documents they're looking at, and so it gives you a good sense for their level of interest. And are they just kind of peeking, or are they truly interested in doing due diligence? So I would highly recommend that you get that set up in Carta.
Yeah. Let me tell you an interesting story that might help. So get your data room set up now. We were looking at a deal that presented to our group about 2 months ago now. We were interested in going into diligence with them. They were interested. Now, granted, this company has raised, I think, like 6 million plus prior, but they didn't allow us access to their data room until almost last week or 2 weeks ago. So it delayed the whole diligence process for us. And they were looking for funding before the end of this year. And we're like, hey, we're not going to write any new checks now until the beginning of the new year. So you missed your timing window. So again, it's better to have that prepared now and be able to share that at a moment's notice, if you will, so that you can start the diligence process sooner rather than later. As I mentioned, this other company, they deferred it and delayed it and delayed it and delayed it and gave us kind of a runaround until they finally allowed us access. Now, granted, they probably have their own reasons for it that I won't go into, but it just delayed the whole funding process and really discouraged us because we were assessing the team saying, hey, they're not really as responsive or not really as forthcoming and not really sharing all the details we're looking for and delaying the whole timeline. So I digress, but hopefully that's just a helpful story.
And when you look at that cap table, let's go back to that. How do you want to see a co-founding team split that equity or the majority ownership?
I mean, there's some, again, it's all mental model stuff, right? But we want to see the founder CEO have meaningful equity. We don't want to see 4 co-founders with equal equity because that speaks to, quite frankly, poor leadership. Not having an inability to have the hard conversation about each person's value at the beginning of the venture, and it just causes trouble later when people leave the company. We are very, very cautious around family members. What are the odds that the 2 best people to run this company happen to be brother and sister or happen to be husband and wife? More often than not, one of them is really doing the work and the other one happens to be the spouse or the sister or the brother. And so, we're cautious about things like that. And then we're cautious about equity that has gone away to far off lands and people who are no longer involved in the venture who aren't going to bring value moving forward.
Well articulated, exactly. Nothing else to add there.
What about paying people in equity early on?
Oh, we don't have any problem with that. In fact, that's actually a really good use of a safe. Safes are a really easy way to pay your web developer or if they're willing to take equity. We want to be careful about, early, particularly like friends and family investments. We want to make sure that they're papered properly. I mean, there's so many horror stories about you take money from Aunt Judy, and if the company is wildly successful, she's certain it was stock, and if it fails, she's certain it was a loan and wants you to pay it back. And and it's it just makes for a really uncomfortable Thanksgiving or Christmas. And so we want to, if we're now actually getting involved in the company, we want to get all that stuff cleaned up before we put our money in.
All right, any questions from the audience? Go ahead and raise your digital hand or put it in the chat. So JC, you said you don't, oh, here we go. Riza, go ahead, ask your question. Unmute yourself, please.
I just want to thanks everybody. This was very helpful to see JC and Dean, and this meeting was very, very informative. Thank you.
Very welcome. Good to see you again.
Thank you.
All right, and we have Garrett.
Okay, so I have a question for Patrick and JC and New Fun again. How does it work if you're closing around with a grant and venture funds? How do the terms get together if, say, you're leading the round, JC, and New Fund's in the round as well, and Patrick's got this NIH grant and he wants to add that in? Is that an in-between grant, or do you have to close your initial safe and then add on that grant? How does that work?
No,
It's just parallel, it's separate. It doesn't really factor into the valuation. Yeah, it's just a separate thing, right? I mean, I don't want to speak for you, JC and Dean, but you guys don't factor that into your valuation. It's a plus because it's non-dilutive.
Yeah. It may increase your value, that company's valuation, because it gives validation, hey, they've done this. So when you're negotiating valuation, it may go, hey, okay, you're at 8 million, we're at 10. Okay, now that you have this non-dilutive, we'll meet in the middle, because it validates that now you're at 9. Whatever it might be, it can be helpful. But it is a completely separate, it's not affecting really our valuation or anything like that, or our investment. It's just helpful for the startup because it increases their potential success because they have non-dilutive funding back behind them.
I think it does. What's the word? Inspire us to consider a higher valuation. If you're a life science company, maybe it's IP that's coming out of a university lab. It's been worked on for 5 or 10 years. They've raised 15, $20 million. There's been a lot of work done. We're going to sort of make the leap that 15 or $20 million has been value has been created in that IP. And it will influence what we consider paying for it. I mean, we want to be forward looking. We don't want to just do a rubber stamp and add $20 million to the valuation, but we'll see that company likely higher value than somebody who didn't raise that non-dilutive funding. I mean, one SBIR phase 1 for 100K is not going to be relevant.
But it's not part of the round, I think, for clarity. Your SBIR non-dilutive funding is not, you don't fill that in your round. It's separately next to the round.
Yep.
And another thing we look at that's negative is this SBIR, is this non-dilutive funding going to be distracting because the funding source wants you to do something other than what we want you to do? Maybe it's not helping you commercialize a product, it's just paying the bills. And so we look for that as well.
Thank you.
All right. Anything else to add? All right, we have a question from Andre. Go ahead and unmute yourself.
Yep. Hey, everyone. My name's Andre. I'm a machine learning engineer. I'm the founder of a sports AI company. And back to Amy's question from a little while ago, she asked the "what do you look for" question, and I found it interesting that no one mentioned a revenue minimum. I expected to hear a 10,000 or sort of answer per month. I'm a SaaS business and I have a functioning MVP, early customers, a solid team, a big vision. But based on what you guys said, it sounds like I could warrant asking for millions of dollars. And that'd be surprising for me. I have a hard time asking my family for $1,000. So, also, if you guys, one more follow-up point to that is just when you mentioned lifetime value and customer acquisition costs, and those calculations take more time to get real numbers on that. So where is the balance on this? Thank you.
Want to go first, JC?
Either or. I heard you go first. I'll let you go.
All right. Yeah. So Andre, congratulations on getting to that point. So SaaS plays are actually pretty easy. If you have developed a minimum viable product, if you have attracted arm's length customers at any level, and those arm's length customers has been given you a credit card for you to bill every month, or have entered into a contract where you're paying by the year, we are interested in you. You need to get past your self-limiting beliefs that your venture is not worth millions of dollars, and you need to show up in front of investors and make it clear to them that they are so lucky they met you today. So, I don't know a lot about your venture. I might, dig in. I'm happy to connect with you and explore it further. But,
Absolutely.
At the end of the day, dispense with the idea that because my venture is only generating $40,000 a year, that somehow it's only worth $100,000. Because presumably you've built something that has value. We'll evaluate that. If we believe that we can hire an offshore team with 2 developers and build the same exact thing in 2 months, then it's going to be valued less. If you've done something truly innovative and there is some sort of competitive advantage, we're going to be excited about that. And it's a crass sort of analogy, but in venture we always talk about, are the dogs eating the dog food? Are you getting people to sniff around your product, they're adopting it, and then they're just devouring it? And in SaaS, you measure that through churn and retention. Are people who tried it the first month using it the second month, and they're using it the third month? It's a little bit easy it's a little bit harder if it's a brand new venture, but those are the things we look for.
Yeah, complete agreement, Dean. We don't have any, to go to your first question, we don't have any about revenue expectations. If you have 0, that's fine. We'll still take a look. If you have 100,000, that's great. If you have 1 million, that's even better. But we're not, we don't have a threshold where you have to hit, this amount. But as Dean mentioned, we want to see that you've got a working MVP, you've got some customer traction validation, that's where we get excited and go, okay, how can you really expand this and grow this? And then we'll dive in further and really unpack a lot more. But very exciting. Congratulations.
Yep. Thank you so much. Much appreciated.
All right, so maybe we could talk about, I want to talk about like the positive things of when you know due diligence is going well, and you're either going to get the funding if you're the founder, or the team feels like we're going to fund the company. And maybe also conversely, the mistakes where something has just gone wrong and the funding isn't going to happen.
Where to start? That's a big question. So if I could say that, we've looked at a lot of deals, we've diligenced a lot of deals. We get excited when, we feel it is a courtship, during the diligence process. We get excited when, there's good communication, clear transparency. We've unpacked, we've done the technical due diligence. We see kind of the vision and the growth of what the company can do. And we also share, our diligence with some other potential, whether it's experts or other funds, and we get kind of their validation as well. That really gets us excited. On the flip side, where I've heard of, we've had a lot of horror stories, is to the same effect, where entrepreneurs aren't as forthcoming or as honest, or trying to overpromise and underdeliver. To give you an example, we had a company we were really excited about that was doing about 3 million in ARR. They were raising a $2 million round. They were having a significant down round. This is about 8 months ago, or maybe even a year ago now. And their valuation had dropped from just around, I think, at like 12 million. So pretty significant down round. And we had a conversation, my partner Mike and I, with the CEO, and the CEO blatantly said, "Oh, hey, Mike, you're connected to so-and-so." And Mike said, "Oh, yeah, I'm very closely connected to that individual." And the guy said, "Oh, yeah, that individual is like my second father, blah, blah, blah." And kind of went off, and like, it's one thing to just say, "Oh, I know that person." But this specific entrepreneur said, "Oh, I know them really well. They were like my second father," and just went on and elaborated that. And Mike and I said, "That's kind of interesting. Well, let's do a quick check on that." Mike gets on the phone right after the call and asks the guy, "Hey, do you know this individual?" And the individual says, "I have no idea who you're talking about. He went to high school with my son, but I don't know him. Never, he's come over to my house one time that I can ever recall." And then, you know, later in the week, I think his son called Mike and said, "I don't like that guy. No, I don't know that guy." So you have to be honest, you have to be forthcoming. Don't go, say things that you're just trying to do to, sweeten up or butter up your potential investor. We're all going to do some cross-checking, whether it's something that's a personal connection or diving into customer exploration or something to that effect. So there's other stories that I have that are similar, but just be honest and forthcoming, and that'll get us excited. Or on the flip side, that'll get us really going, okay, this is not something we want to continue with.
Because it is a small community and everybody kind of knows everybody. And if we are sort of 6 or fewer degrees of separation from someone you know.
With that said, putting my entrepreneur hat on, it is an art for an entrepreneur to be 100% honest and factual and completely misleading. Like that's not like, and I use this example a lot. Like when the founder says we're talking to Sony, we know that it means they sent somebody from Sony an email and they haven't gotten a reply yet. Like that's not disqualifying. Like that's being a hustler in a good way. But there is absolutely crossing a line. JC's example is a clear example of crossing a line. We've had others. We've had falsified customer records. We've had borderline criminal things if they were a public company. And so, you have to kind of play that. We had a portfolio company that said, we're tracking for 10 million in ARR in revenue, and we expect to be cash flow positive in October. And somehow the inexperienced members of our group of New Fund turned that into, that company's doing so great. They're doing $10 million in revenue and they're going to be cash flow positive next month. That's not what the update said. The update said they were tracking for 10 million. They were nowhere near $10 million in revenue. And so those are the things, like there's this entrepreneur's license where, you have to figure out how close you go to that line. But it's not uncommon to be completely honest and a little bit like, cause the investor to dig just a little bit deeper.
I think from an entrepreneur's perspective, it's kind of like a balancing act, right? You have to be able to sell the vision. You also have to be transparent with articulating the risks and what you're planning to do about those risks. And you want to be transparent about things that are happening in your business. But there's also a salesmanship that comes with it, right? And just blending those and finding the right balance is yeah, it's definitely an art and something that I think you have to continuously hone and use every chance that you have to interact with investors. It's really a chance for you to demonstrate what it's like to work with you over time, because especially in a life science company, these are long-term investments, and the investors are thinking about, okay, can I work with this person over X number of years?
And you have to also confidently be able to say no when the answer is no. You have to, like, if they say, what's your IP? We don't have any IP. This is not an IP play. If you require an IP play, we are not a good fit for you. Investors love that confidence. Investors love the fact that they're dealing with an entrepreneur who actually understands, like, the journey that they're on.
And say, I don't know if you don't know.
Yeah. Yeah, there is I appreciate the confidence and optimism of a founder. Like, you can't, I don't think, pursue those efforts without a complete optimistic view. But there's like this reality check of that if those expectations aren't met, then there's, upset investors. So we have a question from Malte. Go ahead and unmute yourself.
Yes, thanks. And apologies if this has already been asked. I had like my internet going in and out earlier. But what is your stand on crowdfunding campaigns? Is that something going in there, even especially for SDAC? Is that something have an active equity crowdfunding campaign going on while entering SDAC? Is this something you guys could get behind and involved in, or you want to start with a fresh round?
I mean, so I've been involved in crowdfunding on both sides. The company I'm involved in now raised $8 million, or sorry, $5 million from non-accredited crowdfunding, one of the largest raises when we did it. The downside of crowdfunding. So one of the things that more sophisticated investors dislike is what we call party rounds. A party round is when the entrepreneur sort of passes the hat to friends, family, and others, nobody who does due diligence. And the entrepreneur sets the valuation and somehow it sticks. And then they come to us and we're like, no, this is nuts. Like, this is not, what the valuation of your company is. A non-accredited crowdfunding round is like the mother of all party rounds. You have 500 people you don't know that just took your word for it based on the limited due diligence of what you're required to disclose. So from that perspective, we don't often like them. The other reason we don't like them is because depending on how you did the crowdfunding, if it's not done through what's called a special purpose vehicle, an SPV, where all of those non-accredited small investors are in a single entity, then we have to deal with a cap table with 500 people on it or 300 people on it. And any one of them can get cranky and anybody can sue anybody. And so it just adds complexity to the cap table. But modern crowdfunding takes that away, because most modern crowdfunding, you have one entry on your cap table and it's an LLC.
Yeah, we don't really participate in crowdfunding as a fund, but we don't mind if that company goes out and gets crowdfunding in the same round on the same terms that were set, whether by us or whatever. But yeah, should be by an SPV versus having 100 individuals on your cap table.
And then, of course, as an entrepreneur, B2C, consumer products tend to get more traction with crowdfunding than B2B products. And so you typically want to already have an engaged crowd of some sort who's inspired by the product versus starting from scratch. It just makes it easier.
Right.
I'm curious to see what you do next, Malta. Is it something for my motorcycle?
I don't know, man. I'm still scouting a few ones. So
Okay.
I'm in South America now, and I see a lot of great potentially, and I'm kind of like trying to be kind of like the hub of bringing innovative startups to San Diego.
Got it. Cool. Very cool.
All right, Byron, go ahead with your question.
Yeah, I just had a question on the revenue that you're mentioning for your multiplier, whether it's 10 times or 20 times or whatever. I guess it seems to me like that's a little bit in tension with people talk about finding your beachhead market, which is this tiny little safe space where you're going to start off, and sort of by definition, it's a small market. So I guess like how much credit can you take for, or how long the timeline to say like we're starting here and we're not going to get this, this massive revenue there, but then step 3, 4, 5 or whatever is to grow into these larger markets.
Yeah, so
Go ahead.
go ahead, Dean.
Go ahead, JC.
Okay, so I was going to say, obviously, we love focus first, lowest hanging fruit, prove out that market, prove out your technology works. We want to see other potential, fruit on the tree that you can jump into and tackle. So yes, that does play into effect. And Patrick is a perfect example of what we're looking for. And Patrick, correct me if I'm wrong, you probably won't commercialize until 2026 in methadone, and the target that you're focusing on first. That's $1 billion business in and of its multi-billion dollar business in and of itself. But then there's all the other platform technologies you could do because it's a drug delivery technology. It could go into a lot of other aspects. So, but he still would have to go through clinical studies to go through that to prove that out in efficacy. Hopefully a much faster timeline, but that'll be, we're already looking at 26. So that's, 3, maybe 4 years from now until he really hits good revenue numbers. And then he can expand into other markets. So that's, maybe 7, 8, 10 years. So we're seed stage investors. We're in it for the long haul, to see those big, revenue numbers hopefully grow, one within that focused market, but also extrapolate into other markets as well. Patrick, hopefully I didn't steal too much of your thunder, but I think maybe that's a good segue to get your thoughts on it.
No, I think you articulated it well. The key is if you pick a beachhead market, ideally it's a big one. And then there are others to follow that are even bigger. And in our case, that's certainly the case. But just to clarify, it's not drug delivery. It's no worries. It's monitoring. That would be sort of the closed loop scenario. A lot of people are actually asking us about that. Well, are you also thinking about then delivering the drugs? It's like, well, that's a whole nother steep hill to climb that we're leaving for others. But yeah, I think the key is to do a lot of homework on your beachhead market, know that market inside and out, and instill the confidence that that once your product is ready to go, that the market will adopt it, and that you have a way to get it paid for, and then be able to create the vision that says, okay, well, once we are successful in that market, this is how we'll attack the other ones, and this is the method with which we're going to go about evaluating each one of these opportunities. But you don't want to. The one thing you want to avoid is appearing like you're chasing everything at the same time, right? You want to make sure that you have focus, but also be able to paint the vision for what comes beyond the beachhead market.
Yep. Well said. Very well said. Thank you for that. Okay, Kyle, your question?
We can't hear you. I don't know if you're on mute or still can't hear you. Uh-oh.
Sounds like a use for chat.
There we go.
Oh.
There he is. Yes, we can.
Great. So let's see how I can phrase this. So we kind of have this chicken and egg problem where we're told that we need some validation. We're in health and wellness mobile app space and platform. And so we have an MVP out now, which is great. And so we're in the process of trying to get some traction. We've got like market validation through testing, but now we're going through working on getting the traction. So at what point do we start the fundraising process? Do we wait till the traction's done, or do we start the balls rolling as we try to get traction, assuming that we get the traction we want? So
Yeah, in a mobile app, is it a mobile app or is it a
primarily,
enterprise? Yeah. So I can't speak for JC or others, but for New Fund, we would expect substantial progress to be made before it comes to New Fund. The reason is it's fairly straightforward for an early stage team with a technical founder to develop the MVP of the app. And then it's also fairly straightforward to do some basic customer acquisition. And so, so we would want to see the team demonstrate that they can do that before we valued the company at a sort of venture type valuation or seed valuation. That's different than bringing a drug to market where you actually need tens or hundreds of millions of dollars to actually make progress with that. And one of the challenges we have is we'll have like a team from real estate that wants to create a real estate app, and they don't get that. We don't really care that they have 30 years of real estate experience. We want to know that they know how to do customer acquisition and growth hacking to advance their either SaaS company or their mobile app company, because that's the journey they're on. Like, it's not about real estate. It's about commercializing a mobile app in a sea of millions of mobile apps and figuring out how to get yours to stand above. So we're going to want to see a team sort of show some level of aptitude and progress with that. It doesn't have to be a lot, but it needs to be some level.
Okay.
And if it's a team that's outsourcing development of the app, that's a negative, because it's, you know, a technical founder, nobody pays for them to pull an all-nighter to cut code for 20 hours. And if you're outsourcing, you know, then, you know, your partner has a vested interest in charging you as much money as possible, and that's our money. So that's, you know, that's a little bit of a negative.
what if the technical co-founder has the knowledge to do it, but it makes more sense to hire somebody offshore to do it?
I mean, we've invested in plenty of companies that are in that model, so it's not disqualifying. It's just, I mean, when you look at, like, you know, Microsoft generated millions of dollars of value before they raised money because of technical founders. Facebook generated millions of dollars in value with technical founders. So it's just, you know, it's just, again, it's like you're in due diligence, you're weighing the pros and the cons, and that would be a con, not a pro.
Okay, thanks.
Any other responses from the panel? All right, we will go to Saeed. Oh, wait, go JC.
Oh, no, I said no. Sorry, none for me.
All right, Saeed, go ahead.
Hi, first of all, thanks everyone for a great session. I really enjoyed the conversation and really learned a lot. And I have a couple of questions regarding the 10 to 30x return of investment that was mentioned earlier on. What's the time frame? Oh, how many years are we looking into?
For us, 5 to 10 years. So probably landing somewhere in the middle, about 7, give or take on average. That's kind of the way we've constructed our fund and our thesis and our charter. So we anticipate, you know, 5 is the early and 10 at the later, somewhere landing in between at 7. But we anticipate, hey, it could be even prolonged outside of 10. For some of the life science companies we could potentially invest in.
Perfect. And the second question, you know, we are applied AI company. Business model is hardware-enabled SaaS, and we already secure the customer, have a working MVP, and we should have a revenue by Q2 next year. Is this type of profile something that matches your interest within the investment range, or do you know any other investors that could refer us to, please?
So, yeah, so Saeed, this is a classic example of real due diligence and real time in front of a lot of people. How is it that you have a customer today, but you won't have revenue until Q2 of next year?
Well, the customer is actually, it's a B2B model, and they're actually integrating our AI technology into their products. They're already in the market with about 800K devices per year. So they're integrating our AI technology. We've been engaged with them for a couple of years, and, you know, they're going through all the technology evaluation, and tests and etc. But they gradually took it more and more serious and started to kind of invest in it and the next generation of product.
Yeah. So that would be something we would want to dig in on, because I wouldn't necessarily refer to them as a customer unless they're paying you something. And it sounds like you're in sort of like a proof of concept or a pilot project that you're paying for, that they're not paying for.
They already kind of gave us a PO for the upcoming. Plus, there's a ROI and all the agreements. So
yeah, it sounds exciting, and we're happy to look at it if you're at that point. Yeah.
Sure, thank you.
Same from us at CoFund.
Thank you.
Maybe we'll do a Shark Tank thing, JC, where
I'm all for it. I'm all for it.
You could be Richard Branson and pour water on me, and
I wanted to be who's the Dallas Mavericks owner? I forget. Mark
Cuban. Yeah.
All right, we're almost to the top of the hour. Any other questions you guys this is your chance, this rare event to get 2 fund managers from local funds, to just ask them anything you want. Put it in the chat. You can private chat me, but you really should reveal yourself. I should ask Patrick, because next up, Misty is going to introduce the SDAC due diligence folders, which I imagine you did. Did you feel you populated the SDAC folders at one point?
Yes, we did, and we actually used it as a model to then build our data room on Carta, and we expanded it from there. But we used the same categories, we used the same nomenclature, and basically, it's a great foundation. And I would highly recommend that you use that, you adopt it, and then get it on Carta, something similar, as quickly as possible.
And then, so tell us what benefit Carta provides for this.
Well, the biggest benefit that I see, one, it's in one place where we keep everything as it relates to our cap table and so forth. The big benefit for me is that I can see who actually logged in, who looked at the documents, which documents did they look at? Did they look at any documents multiple times? So it gives me great insight in terms of how many people are conducting the due diligence from a certain fund, and who's looking at what, and I can just gauge their level of interest based on that, and I can kind of anticipate the questions that are going to come up as a result of what they're looking at in the data room. So it's invaluable. It's much better than just giving someone access to a shared drive and then not knowing if anybody looking at it, or what are they looking at, and it just gives you a lot more insights as a founder.
And now you can share that Carta drive or Carta location with a new group that's doing due diligence, and is that satisfactory, or do they ever require you to conform to their folders?
So far, everybody's been. It's kind of if you use Carta, it's kind of like incorporating your company in Delaware, right? Nobody's going to question that. So.
Yeah. All right, we have a question from Drew.
Yes, hi. Thank you guys again so much for your time. This has been incredible. I wanted to ask Dean. I looked at the link that you sent me for SandCloud, the company that you helped prep for Shark Tank, and you hosted the viewing party for them and then helped them negotiate with Robert Herjavec, and that was really amazing. I was tearing up. It was a very inspiring story. And I wanted to ask if I could please schedule like 10 or 15 minutes with you to share with you more about my company, Lightning Drums. I know your time is very valuable. I really respect your time, but I just wanted to ask you while the floor is open.
Yeah. Just connect. Well, first of all, Drew, just Amy, take note. Drew was not paying attention for at least a half hour while he was reading my article.
I was, yeah.
Drew, just reach out to me on LinkedIn or send me an email, and I can maybe connect you to the SandCloud guys, or we can talk and see what you're up to.
Okay, thank you so much. I really appreciate it.
Yeah, and come to our pitch deconstruction. I know Drew's pitched before there. That next one is my notes again. That is going to be December 12th. So I hope everybody here comes and does a 1-minute pitch. And then we vote, you know how that works. We all vote in a little sheet that everybody can see. The person with the 3 or 4 companies with the most votes go on and do a 3-minute pitch with slides, and then they get direct feedback from the panel of judges. So it's a very valuable experience. So I think if we don't have any more questions, we'll transition to our next phase, which is Misty and her due diligence folders. But before we do that, let's give everybody a digital round of applause for our speakers with JC and Dean and Patrick. Thank you so much for sharing this, because this deal room is the room where it happens, right? When the investors talk, they look at your stuff, and then so it's something we don't really get to hear much about. So I was very grateful that you guys were able to join and share how you approach it at your fund. So thank you very much. I think now we will transition to, we're going to do like a 5-minute break. We'll come back let's come back at 8:10, and Misty can share and then get her prep to share her due diligence folder. So thank you very much for the speakers, and thank you for our audience for your questions, and we'll see you at 8:10.
Thank you.
Yo.
All right, it's 8:10. I just wanted to remind everyone of the key dates. We have 3 more SDACs, E-Tracks left. Next week we'll be on Zoom. That'll be December 5th, 5:30. We're going to talk about business models, the channels. So how you're going to reach your customers, your go-to-market strategy. And so we'll have Maria Blanche Gonzalez from Crescent Partners and Hillary McCarthy from ClearPoint and Natalie Castellana from Aptera to give us the founder's perspective. So I will stop sharing that. Make sure everybody's back in the room. Got a little break. We got some great information from our fund groups. And so now we're going to bring on our executive director of the Free Enterprise Institute. That's Misty Rusk, who's been running the San Diego Angel Conference, came and founded it for SDAC 1 back in 2019, earlier than that, but the conference was on in 2019. And now we're kicking off SDAC 6. So Misty, I know we're having a little bit of technical internet challenges, but I think you're there.
I'm here. Can you hear me okay?
Yeah, very good. Welcome. Thanks for joining.
Video on the computer and the sound through my phone. So whatever it takes to make it work sometimes. Stephen, you've got the participant screen sharing disabled. If you can give me access, it'd be great. I'm just going to do a quick share. I think it's really sweet that Patrick said nice things about our due diligence process and what we required him to do. That was the first year we really changed the process, and he probably shouldn't have said such nice things. We probably run one of the most difficult due diligence processes out there, because our fundamental issue is we are trying to activate more angel investors. And so it's important for us from a teaching perspective to be able to give things to our investors quickly and have them be able to look for things in a very similar kind of way. We're kind of bridging the gap. With that said, if you can survive that due diligence process, just building the vault out or the data room, it's referred to often that way, then you will have a much easier time going forward. All right, let me try this again. Like I can share. All right, so I just pulled up the application page of the San Diego Angel Conference website. We are less than 3 weeks away, so I thought that's fun. I always love this counter that Jad put together for us a couple years ago. And it's kind of nice to see the time ticking down, unless of course you're trying to get that application done. And so I have shared in the chat twice the link to this vault. So I'm just opening this folder that we call Vault Sample to share with E-Track founders. And all of you should be able to view it, and you should be able to download anything here. So the important thing about these folders is these are empty. This is just the simplest way we can think of to categorize the folders in a way that makes sense. And then when somebody gets moved to the finals and they enter our due diligence process, we set up a folder. It's an exact copy of this folder for each of the finalists. And then we ask them to put all of their documents in our shared drive and with our naming convention. So that's a little bit of the naming convention is where we make it harder. I'm actually kind of glad that we had the little break and JC and Dean got to go have some dinner, and they're not going to watch what I'm going to tell you guys, because they would probably call and chastise me a little bit later for how there's a bit of arduousness in this, but it's mostly so that we can use it as a good teaching tool and put your information uniformly in front of investors in a way that makes sense. So when I open this due diligence questionnaire, you're going to notice that this looks a lot, like significantly like the one from New Fund. As a matter of fact, the only thing that's really different is that we've changed the footer and we've added our logo. But we do this to work closely with New Fund because we source a ton of deals with them. So if you can do this questionnaire, it's an easy switch to new fund if you make it to their due diligence process. So there's a couple of things that we do that do make it easier for you. If I go back to that folder, this is where it gets difficult. And if Patrick is still on, man, if you want to go back and relive some of this experience, I will let you back up and say something different than what you said before. So for every file that we ask for, we are asking for you to put it, not in these color codes, because of course you can't do that. This is just what we ask for people to do. So we ask you to start with a code. I'll show you what that means in a second. And then the file title. And then we ask everybody to put their company name, highlights in a weird way. We ask everybody to put their company name and then the date of that file. And it makes it easy for us to sort multiple documents that are similar, because oftentimes there are updates over time. It makes it easy for us to look at which companies or really specific things. And it makes it very simple for us to look across companies quickly. So if we're looking for product specs, we can go to our big vault and we can search for all of the files that start with the letters B1. All right, so let me go back and show you this third piece. This third piece, and this is the categorization. So venture capitalists always tell me, don't apologize for doing this, but it is a big list in the angel environment, but it really will set you up. And so if you're wondering what kinds of documents you need to put in your vault, this list of categories and codes names it specifically. So if I, as an investor, if I want to find where they put the cap table, I can quickly find that all the cap tables would start with a file name of A9. And then I can pull cap tables from across. And when you put things in this order, it makes it pretty easy for us to navigate, but it'll also be easy for you to keep track of where you're at. So Patrick might have actually had some suggestions. He was able to do this. He and his team did this really quickly during the year when they were part of the San Diego Angel Conference. And he might have some tips and tricks if he's still around and wants to share. If I remember right, he paid some folks and they went in over a weekend and they refiled all of their docs into our shared folders, into our vault. So we can go back to this, but that's, as much as like the due diligence process is a arduous one and it's a big lift, a vault can be as simple as, a few folders and a way for you to put all your documents together. And if you build your vault as you go, then it's really easy to turn it around for a group of investors. That's the big heavy presentation for us on the due diligence. I've just given you all the tools that we use. Would love to invite you to use those as you start to organize your documents and start to think through, where those different things are. A lot of times we find that, actually, where are our organizing documents? Oh, that last set, the definitive place for those is in my email, and then, an email that came from my attorney or something. So taking some time at this stage, when you're still setting up a lot of those things, can be a lot easier if you get them organized well, so that when somebody asks you for access to your data room or access to your vault, you can do it really fast. Amy, how's that?
Yes, thank you, Misty. We have a question. Does the folder need to be done by December 19th?
Oh, yeah, good question, Drew. No. So, and unless you make it to the finals, we will never ask for it. But you can take that framework and you can make your own set of files. So we do it in a shared drive. We do some extra things to do some information protection on top of our regular stuff. But unless you become a finalist in our process, we won't be asking for this. This is not part of the application.
Okay, and then Misty put in the chat, she's calling it sample vault. She's calling it a vault, which is sometimes you'll hear deal room, data room, or vault. And so if you see in the chat, she put a link to that Google Drive, and she just put it in again. So and then Stephen will send that out to you in the follow-up email with all the other slides from today. Does anyone have any questions
That
about?
vault also includes that vault also includes that checklist. It literally is the same one that New Fund uses. Every year we go and we compare documents to make sure that the questions we're asking aligns with what they're asking, to just make it easier for San Diego-based businesses.
Yeah, I think it's important you don't need it now. You will need it. And when you'll know if you don't have anything close to the information available, are you ready? We talked, the JC and Dean talked about that. But if you feel like you're going to be entering due diligence, it's better to have that sooner than later. So at least know that it's coming. Start organizing your information when you have time, as opposed to when you're in a crunch. Does anyone have questions about the application or how SDAC works? Because we got Misty here. You raise your digital hand, put it in the chat. The applications are due.
Yeah.
Yeah, okay, we got a question?
Yeah. Sorry, I didn't raise my digital hand. Got me?
Go ahead.
Yeah. Okay, so I think this question is for Misty, but I like all your answers, so it's good. But I keep struggling with how much I'm actually going to need to. So I'm used to operating like the minimum I need to operate, but to really go to market and build what I really would fully like to do. So investors are capital. I think Misty mentioned that so $5 million is maybe for angel investment, but your capital is until $2 million. Get that?
Okay, you're it's breaking up pretty bad for me, and I think I can tell by Amy's expression that it's not just me, but I think you're asking an ask question. So like how much money should you be asking for in this process? And we get everything from like, oh, I don't know how to do this, so I'm, if I get this money, I can make it work with 200,000. We typically don't want to be the only money in on a deal. So if you're raising somewhere between $1 and $2 million, that's a good number to be raising for our group. Still feels like a couple $100,000 will make a difference for where you need to get to, but it doesn't put all of the weight on our shoulders to try and fund your success. So that's an important consideration. The first session this cycle for the e-track, we covered how to build an ask slide based on overcoming risk, and that's a really unique way to do it. If you look at the runway that you need, 18 to 24 months. Since COVID, we've seen those stretch out. Like the longer the runway, the better. We're still seeing, 24 months is probably a good amount. And if in the next 24 months, for you to be hitting all the targets you need to do to hit that growth curve that an investor wants. So I'm going to say on the low side, a 10x return in 5 years. What are the milestones that have to happen in the next 24 months that are going to help you hit that target, like that 10x return in 5 years? And then build backward from that. So overcoming risk, that's like, how do you overcome competitive risk, or how do you overcome environmental risk, or product facing risk, or market risk? Like there's a bunch of those kinds of things that you have to overcome. And then there's just what do you have to build? Where do you need to get to sales wise? So a good ask slide is usually 2/3 to 3/4 and sales and marketing opportunity. We're the only way you're going to get to those kinds of returns is if we are helping fund up the sales. And so if you know you still have to get a build done on top of that, you need to take that into consideration and make sure that the story makes sense and that you can deliver on what you're proposing. Because as much as we're looking at, numerically, like, does the stuff pencil out? We're also looking at, like, do we have confidence that this team can get us there on this product? Does that make sense? I feel like I just said about 50 different topics and I rammed them all into one long sentence.
That's awesome. I had no audio for the first part of it, but I think Steven's gonna send out stuff and I'll be able to listen to it again. And I heard the last part, so I guess it seems to make sense to me as far as the team, and 24 months, 5 years. Yeah, I got that. So thank you.
All right, there's a question in the chat, Misty, where somebody applied for SDAC but hasn't heard back.
Okay.
So what happens when you apply?
Okay.
Should you get a receipt or an email or?
Yeah. I was just going to quick finish, Melissa, and this is really for everybody. If you missed any of the sessions or now you realize, oh, I need to go back and review a chunk, if you go to the website and you go to the events tab, so it's this tab here, or you can just type in, thefdangels.com/events. They'll take you to this page and it'll show you the resources from all of the sessions. You can go back and we publish all of those to make it easy to get back to. So here's that one on use of funds here that Stephen put in. Okay, so I'm going to stop sharing there, just so you know that you can get back to that. Amy, to the next question about how do you know?
Yes,
if you did not, if you went into Gus and you did not get asked for money, you have not finished the application. If you think that you've done that, if it's in the chat, I'll go look. Because I can go check and see if it's done. I can't see who's in process. So you can always send an email to info@VSDAngels. That's one way, or to FEI@sandiego.edu, and anybody on our team can go and take a look and see if your application is there. Drew, you've got a hand up.
Yes. Hi, Missy. Thank you so much for everything. I really appreciate you. I just wanted to ask, I have this, I got this at our last in-person meeting, presenting to angel investors introduction, and it has all these different recommended slides on it. Does that mean like it's like I need to reformat my pitch deck according to this, like what's in this package, or is this a suggestion? And is it like highly suggested I do that? Also, I just wanted to ask how long I should expect the application process to take.
Sure. If you have all of your information together, that application process is still going to take you a couple of hours. We're not playing around. We're asking for a ton of information, and that's if you have everything you need. We're going to ask for financials. We're going to ask for a 60-second video. We're going to want you to upload your deck. You're basically going to, in 200 characters at a time, you're going to basically build an executive summary by answering questions, but on our end, it shows up as a very uniform executive summary. So you're going to be asked to do some of those kinds of things. What was the first part of your question?
Thank you. So the first, I'll say the first part of my question, but I also wanted to ask off what you just said, if there's like if you guys have like a one sheet available for all those things that I should get prepared for the application, or if I just got to do it on the website. And then the other part of my question was, so I got this suggested slides. This is like a printed out pitch deck that you guys gave me in this lovely package at the last meeting. And I was wondering if I need to reformat my pitch deck to be like this. Because I
Yes,
used a different
don't
template to make mine.
reformat your pitch deck. Don't reformat your pitch deck. That's not what we want to. We don't want you to do that.
Okay.
We put that deck together so that the origin of that deck was Boise Angels, and then the Fresno Angel Group also used that, and it was a mandated deck. If you wanted to participate in either of those funds, you had to use their deck and their format. And they did that because they were getting so many applications that when it would come time to pick which companies they were going to look at for the pre-screening, they would print all of those a page at a time, and they'd go in a conference room and they'd lay them out so that they could just put all the decks sort of side by side and pick which ones they were going to bring in. So it from a formatting, and from an ease of use, that's a handy thing to have. We use it because we know real investors, look at it, and because it's been a good teaching tool. Amy and I went through it, made some updates to it this summer. We tend to do that every summer, coming into a cycle, like what's really trending, what's changing. But it's not, we don't even want you to do that. So we want you to take a good look at it, make sure all of those pieces are incorporated, but make sure that you tell your story in the way that's best for you. So we've had everything from, like, I can even think of one specific company that over the last 5 years, that deck has evolved so much, because when she first started, what she had was like her educational credentials and her personal story. And now, so she led with that, because that was the best way she could put her foot forward, 5 or 6 years ago. Now she's got customers and sales and like lots of traction and this killer advisory board. The story looks much differently based on where she's at, and every one of you should do the same. Does that make sense?
Thank you so much. Is there like a one sheet on those things, maybe for the application?
Yeah,
or no?
the one sheet. So I switched over a couple, like 4 or 5 years ago. I had a dummy application that I put in, and I'm not 100% sure that I can see it. But when you're in your application, there is a place that shows you your progress, and it doesn't look exactly like this, but it looks kind of like this. So it has headers that are green with these, white circles with the green check mark, and then once that section's completed, it turns into a green circle with a white check mark. And so if you can find, as an investor, I can't see what you can see. The platform works differently depending on which side of the platform you're on. So investors never see this, but for all of you that are in the application process, it looks kind of like this, but it's a box, and it has about, there's probably about 15 or 20 different things. And if somebody has a screenshot of where they're at in the application and you can drop that in the chat, that would be awesome. But we can't see it.
Thank you so much.
Yeah. Hopefully that's helpful. And again, the best way to know if you finish the application is you get asked for $149. So, and then we can check.
Okay. Can I ask one more question? Sorry, I wanted to ask, can I put a video in my pitch deck for the pitch deck? I'm assuming I have to put my pitch deck in the application. Will it let me upload that, or maybe should I put a link?
Your deck will go
on
in the application. You can put a link on the pitch deck, but there's a better way to do that. If you go to the,
because I know I can upload a video to a PowerPoint slide. Is it okay to do that, or with the file may be too large?
There's a place in there where we actually ask you to put a video in. So,
okay.
And in the FAQ on the apply page, so we definitely want everybody to put a 60-second video in. So when the applications close and investors start looking at the materials on February the 6th, one of the things that we ask is every investor to look at all of the videos in the first week. Right? So the videos become really important because that's the best place you get to put forward to everybody. And then the investors will get put into groups, and they will each get assigned maybe 10 or 15 deals to look at, that they'll go in and they'll look at all the rest of the materials. So there will be, I don't know, 10 or 15 investors who will take a look at your deal the first week, but every investor is asked to look at all of the videos. And so I think I'm sharing my screen again, but there's I'm on the apply page again, right? So if it looks like this at the top, at the bottom, there's an FAQ. And a couple of years ago, we've done this since SDAC 2. Benton Moore was the fund manager of 2, and he put together this really quick, like, one-page sheet that you can download on how to make a good 60-second video for our purposes. So don't put a 20-minute video in there. Investors won't have time to watch that if they're looking at 100 videos in a week. Try and keep it as close to 60 seconds without going over as you can. And we don't care about video quality. Like, we're not looking for super high production values unless that's in line with your business offering. You know, if video production is what you're offering, that's different. But most of the time, we don't care so much about the production values. And there's on the events page, there's a link to a really good 1-minute video. I have permission to share from the founder. It's a really great video, and it has really poor production values. Like, there's a whole bunch of things that if you just thought as a video, you'd be like, ew. But from an investor's perspective, it gave us this really great understanding of what he was trying to do. So that, if I go back on that same page, it's on the events page. I know that's silly, but the events page is now turned into a resource page. And if you look here on the website, it says this, few examples of pitches from previous conferences. Look at this sample 1-minute pitch. This sample 1-minute pitch.
I wasn't
is
more trying to
take you over
pitch.
to YouTube, and there's a folder.
Okay. The best way to demonstrate lightning drums is either in live performance or video, or pictures. So that was more what I wanted to put the video in there for, was them being played so that the investors could see them live.
Yep, that's a good point. So I'd call that the way you get to demo, right? If you don't get to come in and meet with investors, video is a reasonable way to demo. So just make sure it's short, but that it accurately reflects what you're doing. And that's for everybody. So even if you're doing a platform or an app of some kind, a short video that shows how it walks through the wireframing, or how, you know, what your decision trees look like, those are helpful.
Okay, thank you so much.
That's probably not the advice we're going to give you for a live pitch. We have different advice for when you get invited in for a live pitch. Reza, you've got a hand up.
Thanks.
Reza, your mic's not on.
Thank you, Misty, for your guidance. For this due diligence material, where should we start? I know you show us the format of the files, and we can directly go, and as soon as we become apply, as soon as that, we can start filling out those we can go to the Google Drive. I'm right now in the Google Drive, but should we start changing it? Or should we start copy all of the thing in our another location?
Yeah, I don't think that drive that I shared is going to let you add. I mean, it's going to actually let you add files to those folders, but it's everything right now is set to view only. So I'd highly recommend that you download those and you build your own shared drive in something that you have control over.
Okay, thank you.
And then in terms of like where to start with your organizing documents. You know, like if you've got your incorporation papers from your, you know, when you first set up the company, that's that's a good place to start. And then, ask yourself what other legal documents would be, good for investors to look at, or how can I demonstrate what our customer relationships look like through the paperwork that's in place. So that can be letters of intent, or it could be purchase orders, or it could be a whole variety of things. So just start working your way around and just filling those in. You can actually use that that sheet that's the checkoff sheet, or the sheet that shows the naming convention, where it says like all of the coding and things. You can use that as a checkoff list. And so if you go through there and like, I don't have that, that's okay. Like, we expect that most of you don't have a lot of these things. You're really early stage companies, a lot of you. And as your company grows up, you'll have more of those things, but it'll give you the framework to say like, oh, here's where I should place my, patent application, or my or the letter from USPTO that shows that my, my patent's been confirmed.
Okay.
Like all of those things need to get in there, but it's
okay. So for patents, it's very clear that those 2 patents that we have been granted, we have a letter, we just put it there. Okay. And for the customer relation, could be like a letter of satisfaction or something from customer.
Could be testimonials are fine. Like, just think about, you just want somebody to be able to open that vault and be able to quickly find what they're looking for. So making sure it's organized in a way that they can find it is important.
Thank you. Thank you.
All right. On my screen, I've got Melissa and then Malte.
Hopefully you can hear me
Go
now.
ahead.
Cool.
Yeah, I hear you.
So we can't get into the events. It looks like we need permission. So maybe somebody could open that up, the SDAC events page that you were showing us.
So all those resources tabs are locking you out of the Google Drive. Okay, we'll have Stephen look into that.
Okay. Thank you. We're in the one that has the ABCD folder. We can get into that one fine, but the event one on the other page. Okay.
Was it a specific event or all of the events?
Well, the ones that Misty just showed, that's like class 1, and I wanted to go back and look at the resources there. That web page.
Can't open any of them.
Okay, I think Stephen is working on it right now.
Okay, it's in the chat. Robbie put it in the chat. Thank you.
Perfect. 2 questions. Hi, Misty. First question is it going to be similar to the last SDAC where you have the deadline for the application on the 19th, but still kind of like until January to work on the GUST profile? And second question, do you allow any foreign entities to apply to SDAC at all?
We are also ill prepared to deal with a foreign entity. However, we think we could figure out Mexico, and we're pretty sure we can figure out Canada, and we could take the others on a case-by-case basis. So we can't make any guarantees that we can figure it out, or that the investors are going to have the temperament to be able to do that amount of learning. So I'd say maybe not really. We're probably not real well geared up to deal with foreign entities at this time. So for investors, the big concern is if you step outside the United States, and you have an issue, legally, how do you deal with it, right? So one of the things that we know is, one, everybody wants to do the Delaware C Corporation, and most of us don't understand why. But the real reason is we've got 132 years of precedent that back up and substantiate decision-making over a long, long period of time that's favorable for getting business done. That's the real value of Delaware. Nevada's rules actually match it now. They just don't have the 100+ years of precedent to back up and substantiate that. We step outside the United States, then it's a whole new game, and it's a lot for us to learn. And then the first question you asked was, is there some room from the application deadline and opportunity to keep working? Yes, after the application deadline closes on December the 19th at like 11:59, then usually we have about 2.5 weeks, and Amy's team tries to jump in and look at as many of the deals as they can and try and give feedback to help you like really sharpen that up. This year we have the biggest window for that we've ever had. So we actually have until February 6th. We are not giving investors access to the deals until February 6th. So if you get to the application deadline and you realize there's one of those boxes that you just can't check off, you can put a placeholder in so you can get the box checked and paid that application fee. And then you've really got about 5 weeks to continue to, like if you're waiting on something from a key vendor or a document you need back from your attorney or a partner or something like that, there will be some time that you'll have to be able to continue to work on that. And we expect that the companies that do well in the process, they're going to keep updating their the information in Gust all the way through the finale, because that's where investors are going to keep looking, and companies that are really doing well, they're going to have updates. You're going to land a key customer, you're going to win a key contract, you're going to get a grant. There's going to be some intellectual property is going to come through. Things will be happening in that period of time while we're making decisions, and we want you to keep updating your Gust profile all the way through the finale in May. Okay, Amy, do we have any other questions? Is everybody able to get access to those resources now?
Yeah, I think it looks like we're good. Yeah, Stephen fixed it, and yay. All right. Well, thanks for staying late. And Misty, thanks for answering those questions about SDAC. We're meeting again next week on Zoom for business models, channel, specifically PR, and go-to-market strategy. And and we're going to have, I forgot to mention, John Seacrest will be here from the Seattle Angel Conference. So we have 4 speakers. And so it just kind of wrapping up that last part of the slide deck on how you're going to reach customers. So I hope to see you all back here. Thanks for joining us, and have a great rest of your evening. Bye.
All right. Thank you guys. Appreciate you.
Thank you.